Okay, so hello everyone, and we would be doing a quick revision overall for CA Inter Consolidation. This is a part of your paper 5 advanced accounts, and probably this is the most advanced part in your advanced accounts. So this is something which is likely to come for around 10 to 15 marks in your main exams. Usually does not come in the compulsory section at CA Inter. Most of the times at CA Final this lands up in the compulsory section. So having a good base for this at CA Inter does really help. What is consolidated financial statements? Why do we need consolidated financial statements? So we have fairly limited time. What we'll try to do is we will try to discuss the concepts, the theory. This is a revision class. We will also do a few practical problems, at least a discussion of practical problems about the various varieties which can come in your exams. The weightage overall I would say is around 10 to 15 marks. So what is consolidated financial statements? Why do we need to prepare consolidated financial statements? Now if you look at a company like Reliance Industries Limited, it has various subsidiaries. Subsidiaries are separate legal entities, like you have Reliance Jio, which is a separate legal entity in which Reliance owns, let us say, 70% stake. Reliance Retail, which is a separate legal entity in which Reliance, let us say, owns 100% stake. Now when you look at the balance sheet of Reliance Industries Limited, its investments in Reliance Jio or its investments in Reliance Retail will appear as a single line item saying investments. Now in reality, if you look at the price of Reliance right now, it is going up significantly. A lot of it is because Jio is performing exceedingly well, Reliance Retail is performing exceedingly well. So when the shareholders, when the stock market, when everyone looks at the performance of Reliance, they don't just judge Reliance by its flagship, let's say oil and gas or petrochemical business. They also look at the overall business that it has, whether directly or indirectly through its subsidiaries. So when we want to assess financial performance, it is very important that we try to look at the performance of the company as a whole. When I say company as a whole, the company might have invested in a telecom business through a subsidiary. However, at the end of the day, because it has control over the subsidiary, it is able to direct the relevant activities. It is able to decide what plans to offer, what prices to charge, what companies to acquire, which states to cater. So over here, the performance of Reliance is referred to the overall performance, and as a result, we need to break the legal barrier. Like in your foundation, you might have studied that there's a company which has a separate legal entity and there's a corporate wheel. So over here, what we are trying to do is we are trying to lift the corporate wheel, and we are trying to say that okay, Reliance Industries and Reliance Jio might be two separate entities. However, we treat them as one and the same, and that is why we are preparing combined financials as if they are one and the same. Loosely speaking, this is very similar to if you have studied income tax, clubbing of income. When you look at income tax, you club income of a parent with the minor. So the minor's income is clubbed with the parent to look at the overall income of the parent. In a similar way, the subsidiary's position is kind of consolidated with that of the parent in order to find the overall performance of the company, and that is why you need to prepare consolidated financial statements. Now you guys tell me, is it mandatory to prepare consolidated financial statements, or do you think it is optional? Do you think this is mandatory, or do you think this is optional? What do you guys think? Well, preparing consolidated financial statements is actually mandatory. That's absolutely right, because section 129 of the Companies Act, section 129 of the Companies Act requires you to mandatorily prepare consolidated financial statements. When do you have to prepare? If you have even a single subsidiary or an associate or a joint venture. Now, associate and joint venture are not there in your CA Inter, they will come in your CA Final. Having said that, subsidiary is there in your CA Inter. So what do you mean by let us say a subsidiary? A subsidiary is an entity over which we have control. How do we say that there is a control existing? Well, control exists if the parent owns a greater than 50% stake. Remember, if you are, let us say, an individual who owns 2% stake in Taj Group of Hotels, Let us say the Taj group of hotels has 1,000 rooms spread across the country. If you own a 2% stake in the company, you can't go out and say that, okay, 20 rooms belong to me, chalo khali karo, give me those 20 rooms. No, you can't do that, because you have a 2% stake. This is a financial asset. This is an investment. You have to sit with the dividend. If you get a good capital appreciation, sell it. You do not have the power to tell the general manager of Taj that what is the room rate that should be charged, what should be done with those 20 rooms or 1,000 rooms. You don't have the power to do that. However, when will you get that power? You will get that power if you have more than a 50% stake. If you have a more than 50% stake, then you can direct what is to be done. All the resolutions that have to be passed in the company or appointment of directors cannot be done without your approval. And as a result, with a greater than 50%, not even equal to, greater than 50% stake in the share capital of the company, you can be said to control the company. And if you control the company, that is when we say that the company, the other company is your subsidiary. Are we clear with this? In which case the other company can be said to be a subsidiary. Now, when we look at a holding company, or let us say when we look at a subsidiary, there is a consolidated financial statement requirement under section 129 of the Companies Act. Now, let us say we take a sample balance sheet of a subsidiary. Let us say there is a parent company, let us say there is a subsidiary. We try to prepare a sample balance sheet over here. If I own, let us say, just a second, if there is a company RIL, we are trying to first understand the process of consolidation, steps of consolidation. Remember, this is a process driven chapter. If you understand the steps and the process properly, again, different professors have a different way of explaining the process. However, whatever is most comfortable, as long as you're getting the same answer, everything works. So if there is a company P, which is, let us say, a parent, having a sample balance sheet on 1st April 21, and there is a company S, again have a sample balance sheet of 1st April 2011 or 2021. Let us say, for simplicity, obviously there will be a lot more assets, but for simplicity, let us say both of these companies have land. The parent has a land of 1,000, subsidiary has a land of 500. The parent has an inventory of 500. The subsidiary has an inventory of, let us say, 200. And the parent has a cash balance, let us say, of 2,000. And the subsidiary has a cash balance of, let us say, 1,000. Now, apart from that, obviously there will be some equity share capital, there will be some profit and loss, there might be certain loans. In a similar way, there would be some equity share capital, some profit and loss, there might be some loans. Now, what happens is that on 1st April 21, P acquires, let us say, P acquires 100% stake in S. If P acquires 100% stake in S, let us say by paying for, let us say, just a second, let us say this is a loan balance, let us say is 500, equity share capital is 1,000, and PNL, how much is that? 1,700, let us say PNL is 200 rupees. We are paying, let us say 1,200, 100% stake, let us say we are paying 1,500 rupees for acquiring a 100% stake. If we pay 1,500 rupees, acquire 100% stake, typically we pass the entry investment account debit to bank 1,500. However, this investment gives you an ability to direct the relevant activities. What you want to do with the subsidiaries, assets and liabilities, are you in a position to do? Yes. And as a result, over here, we say that we can control the assets, we can control the liabilities of the subsidiary S, and hence we can try to do what is called as a full consolidation, whereby even if S is a separate legal entity, we will take over assets, we will take over liabilities of S. How much assets and liabilities will you take over? Well, to start with, let us say we take over 500. Why? Because you are acquiring a 100% stake. So 100% of the land belongs to me, 100% of the inventory belongs to me. Okay, if I have acquired a 100% stake for 1,500, let us say, instead of 100%, let us say we acquire, let us say, an 80% stake, let us say for 1,200. Is that possible? We acquire an 80% stake, let us say, for 1,200 rupees, in which case, in the parent's books, the cash will no longer be 2,000. In the parent's standalone financial statements, the entry will be investment account debit, let us say, to cash, that will be 1,200, which means the cash will reduce to 800, and there will be an investment there will be an investment in S. There will be an investment in S to the extent of 1200. Now, if I have to take over assets and liabilities, if I have to prepare the combined financial statements, I will take the land of P, then I will take the land of S in my consolidated total CFS, consolidated financial statements. Consolidated means combined financial statements. When I combined, I will say that the land of 1000 which is in the books of the parent will continue as it is. So let us say this is a land of 1000. You guys tell me, what about the subsidiaries land? Should I take over only 80% of the subsidiaries land because I am acquiring an 80% stake, or should I take over 100% of the subsidiaries land? What is your assessment? Should I take over 80% of the subsidiaries land because I have acquired just an 80% stake, or acquire 100%? Even if I have acquired an 80% stake, what is your assessment? What do you guys think? Well, we should acquire the entire 100%. The natural thought process that would come over here is, since we are acquiring an 80% stake, we should acquire 80% of the land. That is incorrect. You do that in case of an amalgamation, you do that in case of an absorption, because you acquire the entire company. The selling company closes, it liquidates. However, when you look at a holding subsidiary relationship, it is not necessary that the selling company liquidates. Like Walmart, for example, has acquired an 80% stake in Flipkart. Flipkart has not liquidated, it's still a separate legal entity. Reliance Industries Limited has a 70% stake in Reliance Jio, it's a separate legal entity. So at what value should you consolidate is a question, and for addressing such issues, there is a separate accounting standard called as AS21, Accounting Standard 21, which will tell you exactly what is to be done. What is accounting standard? We need standardizations. As I can see, some of you have said that we should take 100%, some of you have said we should take 80%, and hence there is some inconsistency. Some would say that since I have an 80% stake, I should acquire 80% of the assets. Some would say, well, I should acquire 100%. Kyun? Humne pehle padha hua hai kya? So ideally, we should acquire 100% of the assets and liabilities, irrespective of whether you own a 51% stake, irrespective of whether you own an 80% stake or a 90% stake. What is the reason behind this? The reason behind this is, if let us say this is a land of, let us say, 100 acres. If I have to decide to sell this land worth 100 acres, can I sell the entire 100 acres or can I sell only 80 acres? What do you guys think? Can I take a decision if P wants to sell this land, the entire 100 acres, or it wants to construct a big head office, or it wants to modify? Can it have the power to do what it wants to do only with the 80 acres of land or the entire 100 acres? Well, it has the power to do what it wants with the entire 100 acres of land, and as a result, even with a 51% stake, even with an 80% stake, I can control. If I am a coaching class and if I have a subsidiary in which I have a 51% stake as well, I can proudly tell to the world that, well, you know what, I have 10 classrooms that I have and another 5 classrooms which my subsidiary has. I might have a 51% stake, but what is to be taught in the classrooms, what is to be done inside those classrooms, I can direct, I can order by virtue of that 51 or 80% stake, and hence AS21 tells you that irrespective of what stake you own, you will consolidate 100% of the assets and liabilities, and hence 500 of land will be taken over. Similarly, when we take inventories, 500 of inventory in parents books, 200 of inventories in subsidiaries books, and so on, you will take over 100% of the assets and liabilities. Are we clear with the reasons? So AS21 will tell you, we are discussing about the consolidation process, where we have AS21 which tells you features of consolidation. All items of assets and liabilities, incomes and expenses should be fully added. That is 100% on a line by line basis, which means each line item, land with land, inventory with inventory, and this is irrespective of the stake held, whether you have a 51% stake or a 100% stake, it does not really matter. But then, isn't that going to result in some kind of inconsistency, because you will consolidate, let's say land, let us say inventory, Also cash 800 and 1000. So you will consolidate cash of 800 and 1000. What do you guys think? Will we also show investment in S in our final balance sheet? What is your sense? Will you show investment in S in your final balance sheet? Please answer. In all likelihood, no, you will not show the investment, because over here you are taking over assets and liabilities of S. These assets and liabilities of S are represented by the investment. So if in my consolidated balance sheet I am showing 500, 200 and 1000 as well, that is represented by the investment. Earlier I was just showing investment, not the assets and liabilities, and hence I was showing the investment. Now if I am taking over the assets, if I am taking over the liabilities, then I cannot again show the investments, and as a result I will have to eliminate the investment. So this is one important consolidation principle where we have to eliminate the investment. We will come to that in some time. You add the assets where you will also add the liabilities. Let us say this is 2000 and 1000, 3000. So just a second, this is what, 1500, 800, 1200, this is 3500. So probably this is 500. I'm just preparing a rough sample balance sheet. So all assets as well as liabilities. So even if there are loans worth 1000 and worth 500 will be consolidated. So if I do nothing over here, I would have taken over 100% of the assets. But let us say if this land is sold, हमने इतना confidence से बोला कि land हमारा है, we can do what we want to do with the land. Yes, you can direct the land. However, let us say this land is sold. This land generates an income. Land is sold, let us say for 500 rupees, 600, 700, whatever rupees. And subsidiary gives a dividend of what it has received. It distributes the money, let us say for simplicity. Will the entire 500 come to the parent only? Please tell me. I have consolidated 500 of subsidiaries land with my books. However, it is possible that eventually you might decide to sell this land, or you might decide to do whatever you want with the land. But if you get money from the land which you as a subsidiary decide to distribute, will the parent get the entire 500? No. Parent will only get 80%. Let's say dividend is given in the ratio of the shareholding. Parent owns only 80%. In which case, if the subsidiary, let us say Reliance Jio, distributes the money, 80% of the money on the land or inventory or whatever it is, cash, will go to the parent. But then where will the 20% go? 20% will go to other shareholders other than the parent. Parent is the majority shareholder, like Reliance Industries is the majority shareholders in Reliance Jio. However, there are around 10 or 11 if you go to see other shareholders in Reliance Jio which own a combined 30% stake, in which case the remaining money will go to those shareholders. Well, they cannot direct what is to be done. However, you cannot say that they will not get anything from the assets, and hence this is the birthplace of minorities interest. You must have heard the terms minorities interest, but why does minorities interest come? Why does it come in consolidation? Why does it not come anywhere else? Because this is a very unique case where you have 80% investment, but you are acquiring 100% of the assets. And hence we have to say that 20% of these assets are not attributable to us. Yes, we can control them, but if money comes, 20% of these assets are attributable to someone else. These are not the controlling shareholders, but these can be called as a minority interest. So this gives birth to the concept of minority interest. Are we clear with this? Do we understand? Okay, so what is a minority's interest? Minority's interest, as the name goes, is the share or the interest that the minority shareholders have in the subsidiary's net assets or the net worth. Why do we have to create minority's interest? What is the birthplace of minority's interest? The fact that you are acquiring 100% of the assets and liabilities, you have to create a minority's interest. Okay, fair. So we will probably keep that in mind. So what we have done over here is we have consolidated all assets and all liabilities. Now investment should not be consolidated because investment is represented by the assets and liabilities of S, which you are already taking over. Now what do you do with investment and what do you do with share capital and reserves? Do you also consolidate the share capital of the parent and the share capital of the subsidiary? What is your understanding? Do we also consolidate the share capital of the parent and the share capital of the subsidiary, like we consolidate the land of the parent and subsidiary, inventory of land and subsidiary? Should you also consolidate the equity share capital of the parent and subsidiary? The answer is no. Well, you will not do that. Why? Because if you go to see, the share capital of subsidiary, that is Reliance Jio, is what? Well, this share capital is of 1000 is nothing but the shares held by Reliance Industries. Like if you remember, if you have done amalgamation, in amalgamation, remember you have intercompany items like debtors and creditors. Do you remember? And in amalgamation, debtors and creditors, you eliminate debtors with creditors. You say it is an intercompany item. In the books of one company there is a debtor, in the other company that's a creditor. We say that let us eliminate it. In a similar way, over here in the books of one company there is an investment, and in the books of other company exactly those shares are appearing as a part of share capital, and as a result we will say that this is like an intercompany item. I am saying I have an investment, the other company says that is share capital, but I have investment in 800 shares of Reliance Jio. Well, those 800 shares of Jio are exactly appearing in the share capital. Acha, but that is only 800 shares. The other 200 shares are not appearing. Okay, the other 200 shares are attributable to minorities interest. And as a result, what you do is, when we will solve this, we will prepare various working notes, and different professors have a different way of preparing this working note. Institute has a different way of preparing. As long as you get the same answer, you don't have to bother. If you have learned a particular technique, you follow that technique. You don't have to necessarily follow what I do or anyone else does. As long as you're getting the same answer, applying the same concepts, it does not really matter. So what we will do is, we will prepare 3 working notes. You can prepare this in the form of ledgers, you can prepare this in the form of statements. Remember, you are now at Inter CA, you are not at 11th and 12th where you are going to be deducted marks because you have done this and that. These are all working notes. Working notes can be prepared in a manner you like. Okay, so what we do is, will the parent's share capital continue to appear in the consolidated balance sheet? The answer is yes. Mukesh Ambani has invested in Reliance Industries. Reliance Industries has invested in Reliance Jio, but Mukesh Ambani's investment in Reliance Industries will continue. So over here there will be equity share capital. Over here, let us say there will be a note on equity share capital, ESC in short, which represents, for example, let us assume these are 200 equity shares of rupees 10 each. 200 equity shares of rupees 10 each. This is parent's share capital, which will appear in the consolidated balance sheet. Only the parent share capital, subsidiary share capital has not yet been considered. Apart from that, there are 3 other things that you need to prepare. First is the consolidated reserves. Consolidated reserves. Second is the statement to calculate goodwill. Why will goodwill come? We will also discuss the logic behind that. Or we can also call this as cost of control. Some people also call this as cost of control. Some people call this as statement to calculate goodwill or capital reserve. And then lastly, we have what you call as minorities interest. Minorities interest. Remember, these 3 working notes are very crucial. So if it's a 12-mark question, be rest assured, if you get even these 3 working notes right, you are definitely getting anywhere between 6 to 8 marks of this question. So these are really important numbers. Now, what is consolidated reserves? Consolidated reserves is the reserves of P and S together. But sir, how can the reserves of P and S together be taken? Well, AS 21 tells you that assets and liabilities have to be consolidated. Share capital has to be eliminated against the investment. Why does it need to be eliminated? We are trying to say, just pay attention, that I have spent 1200 rupees. I have spent 1200 rupees to get a 80% share in the net assets of S. maybe by now you would be aware that net assets which is calculated as assets, ये not दिख रहा है, let's say net assets which is calculated as assets minus liabilities can also be equal to, let us say, the net worth. So this can also be equal to what you call as the net worth. The net worth over here is calculated as equity share capital plus reserves. Have you heard about this before? What is net assets? It is assets minus liabilities, whereas net worth is share capital plus reserves. So over here you have net assets. Net assets will equal the net worth. Okay, what are we doing? Why are we discussing this? Well, when we do the goodwill working, we are saying that there is an investment that was made. This investment was for an 80% stake, and this investment was 1200 rupees. We don't want to show this 1200 in our books of accounts, so we try to eliminate it. We can do it in a statement format, or we can do it in a ledger format. A ledger format is a slightly more easier format to understand. Having said that, most people prefer to do it in a statement format as well, so we are just showing this. So this is investment. Remember what is, if I do this in a ledger format, alternatively, if I prepare what you call as a cost of control account, see, consolidation is a chapter involving certain basic processes. It is important that you know the concept behind those processes to get a clear understanding. Investment as a debit balance, you want to eliminate it, which means you will have to credit it. So investment is credited, something has to be debited. What will you debit? Let us say cost of control. Like in your liquidation chapter or in your amalgamation chapter, you prepare realization account. In realization account, you transfer all the assets. Realization account debit to sundry assets. In a similar way, over here to investments, you will eliminate the investments. How much? 1200. But this investment gives you what? Well, this investment gives you a share in the net assets. Net assets are consolidated, but net assets are also represented by net worth. Share in, let us say, net assets or net worth. How much share in the net worth? If there is a liquidation or if there is a dividend distribution, I will get 80%. 80% of what? Equity share capital. So whatever is the equity share capital of the subsidiary, uska 80%, which is 1000 into 80%, let us say that is 800. Okay. To whom is the remaining 20% attributable? To whom is the remaining perfect? It is attributable to minorities' interest. So we will give an attribution: equity share capital attributed to the minorities' interest. So this is 1000 into 20%. Accounting wise, what that does is you are eliminating the share capital of the subsidiary. Remember, share capital is a credit balance. If you want to eliminate it, you will have to debit it. So by equity share capital, this is 80%, which is 800, and we prepare a separate minorities interest account. And within minorities interest account, you can prepare a ledger also, you can prepare a statement also. You can say by equity share capital, which is 200. So by that, equity share capital is debited by 1000, cost of control is credited by 1000, and your minorities is cost of control is credited by 800, minorities is credited by 200. So with that, in my consolidation, 1000 also has been removed. So what is left? Well, the reserves of the parent, the reserves of the subsidiary, the reserves of the parent will continue to appear. So when you look at consolidated reserves, we typically start with standalone reserves of the parent. So this will continue to appear, let us say, at 500. So we have considered the reserves of the parent as well. So this is the standard process that I prefer. In your steps, you will study this in consolidation. If you get the steps correct, trust me, you just have to spend a few minutes. Otherwise, it is all a process. You get the process right and you get the 16 marks in your pocket. So over here, you will first prepare the Schedule 3 format. After that, you will prepare notes where you will write down all assets, all liabilities as they appear in the balance sheet. Then you prepare 3 working notes. 8 to 10 lines consolidated reserves, 8 to 10 lines goodwill or cost of control, 8 to 10 lines minorities interest. Within that, you will write the standalone parent reserves of 500. If there are multiple reserves, you will do that in a columnar form. So, we were discussing that there is let us say reserves of the subsidiary are the only thing which is remaining. Now these 200 worth of reserves, you guys tell me, these 200 worth of reserves which are there on 1st of April 21 in the subsidiary, are they earned under the parent's regime? Are they earned when the parent was controlling, or they are earned prior to the date when the parent was controlling? It is earned prior, remember, to the date when the parent was controlling, and as a result, these are not profits that are earned by you, but in a way these are profits that are purchased or paid for by you. So if there's a company which is just incorporated and it has a share capital of, let us say, 1000, then you will pay a PC or a purchase consideration for that company accordingly. But if it's a company which has some track record and it has also generated a 200 rupee profit, by the time you're acquiring, you'll probably have to pay a higher purchase consideration or PC, which is the investment. So over here, can I say that if instead of this 200, if this was 2000, can I say your investment will not be 1200? Your investment will be more than 1200. Do you agree to that? If my investment, if my reserves of the subsidiary as on the date of acquisition instead of 200 would be 2000, the subsidiary shareholders will not sell it just for 1200, they will probably ask more. And as a result, what we are doing over here is we are trying to say that the reserves of the subsidiary till the date of acquisition are attributable to the investment, are matched against the investment. So we are saying that till the date of acquisition you earn 200 rupees as a subsidiary. After the date of acquisition you might have very good management, you might earn another 300 rupees after acquisition, but that is under your management, under your control. The 200 rupees which is already there was not under your management, it was under the management of the old shareholders, and hence you will have to compensate them, and hence this 200 rupees of pre-acquisition reserves, 80% of the 200. Now the old shareholders have given you the company, which means that going forward, if a dividend is declared by the subsidiary, 80% of the 200 will still come to the parent, but this was earned in a period which is prior to your date of acquisition, and hence what happens is this is matched against investment. So you will say your share in the pre-acquisition profit and loss will be matched against the investment. So this is 200 into 80% will come to, let us say, 160. But even if it is pre-acquisition, 20% of the pre-acquisition profit and loss is attributable to the minorities, and as a result one can say that we have analyzed even this 200 and we have said this 200 belongs to the parent and it belongs to the investment that the parent has made, not the work or efforts that a parent has done in the reserves. It will be attributable to the investment, and the remaining 20% is attributable to the minorities. With that, you have taken each and every item in the balance sheet of P, each and every balance sheet in each and every line item in the balance sheet of S, and ideally now things should match. So over here you have a total of 800 and 160, that is 960. What does this mean? It means that for getting an 80% share in the net worth, which in today's terms is worth 960, can you alternatively calculate this 960 directly? The answer is yes. You can say that the subsidiary's net worth is 1000 plus 200, that is 1200. 1200 into 80% will come to 960. You have an 80% stake. So ideally you should have made an investment of 960 only. However, you have made an investment actually of 1200. Why have you spent the 240 more? Can you guys tell me? Why have you spent the 240 more? What is the reason why you are spending 240 more? Well, because you are acquiring control over a business, and there are certain assets in a business which cannot come in the balance sheet. Like if you go and acquire Maruti, Maruti has a 40% market share in the Indian car market. That does not appear in Maruti's balance sheet, but if someone acquires Maruti, they get a 40% market share. And hence, these are softer things which don't appear in the balance sheet. However, you have to pay for them if you acquire control over a business. That is called as goodwill. So over here you are paying 1200 for something which is worth 960, and hence 240 is attributable to goodwill. Is everyone clear? Acha. On the other hand, hypothetically, if this was not 1200, let us say if this was 600, then the balancing figure would be 600 minus 960, that is a negative 360. Can I say this is negative goodwill of 360? Do you agree that something like this is called as a negative goodwill of 360? No, this is not a negative goodwill. In fact, that is right. This is called as a capital reserve. Why is it called as a capital reserve? Why not take it to the profit and loss account? Even in AS14 amalgamation, we took it to capital reserve, not in the profit and loss. Any reason why? It's a profit, right? You are getting something at 960. You are getting something worth 960 by paying just 600. So it's actually a profit. But you take it to the capital reserve and not to the profit and loss account. Why? Well, because this is capital in nature. This is a profit on purchase. Till now, every profit that you see is on sale. You sell inventory, you earn a profit. You sell fixed assets, you earn a profit. You take it to the profit and loss account. However, this is a profit on purchase. You are purchasing something and you are paying a lower amount. Typically, profit on purchases are not recorded here. They will have to be recorded in order to ensure that the double entry system of accounting ties up. However, these are profits on purchases, and as a result, since they are profits on purchases, they are treated to be capital profits, and hence they should be taken as a part of capital reserve. They should not be taken to the profit and loss account. In fact, they will be in the capital reserve. So over here, so it is goodwill, so we don't have to bother about that. So this is 240 in goodwill. Apart from that, this 240 can be calculated in various ways. I'll show you 2 or 3 different ways. Exam में आपको जो पसंद आता है, whichever method you are comfortable, you can take. But this is 240. Coincidentally, the minorities interest over here is also coming to 240 by, I mean, it is not at all necessary that it has to be 240 only. It is just a pure coincidence. So how can you cross check these numbers? Let us say for cross checking, you can say what is minorities interest? Minorities interest is in subsidiaries assets of 1700, 20% is attributable to minorities. Subsidiaries liabilities of 500, 20% is attributable to minorities. So your net assets NA of S is 1700 worth of assets minus 500 worth of liabilities, which means 1200 worth of assets. Out of this 1200, 20% is attributable to minorities, which is 240, which is 20% of the net worth or 20% of the net assets, as the case may be. So this is tying up. On the other hand, if you want to cross check goodwill, you can say that how much are we actually paying? We are actually paying something which is 1200 for acquiring 80% stake. So 1200 ka 20% stake is attributed to minorities. Net assets of 1200 into 80% stake is attributable to the parent, and hence for something which is worth 960 you are paying 1200, and hence 240 is attributable to goodwill. So over here, once you do that, there is nothing else remaining. Reserves, there is no reserves of the subsidiary which is attributable to the parent, and hence this is coming to 500. If you want to prepare the consolidated balance sheet, you have enough data now to prepare the consolidated balance sheet. So if I were to prepare the consolidated balance sheet, consol balance sheet, for example, you obviously prepare this in the schedule 3 format, but I need to explain the concept to you, so we can just take a simple T format. There are no adjustments, and hence we can take the total 1500, 700, 1800 and 1500. So these are your line items. So in the consolidated balance sheet, land will appear at a total of 1500, inventories will appear at a total of 700, cash will appear at a total of 1800, and loan, which is a liability, will appear at a total of 1500. Apart from that, there is equity share capital which is going to appear at 2000, which is the parent's share capital. Apart from that, obviously you will have to squeeze in goodwill in the non-current assets. Goodwill comes as a part of your working note too. So you will have to show goodwill in my final balance sheet. It's a special consolidation item which is 240. And apart from that, we will also have to show the reserves. The reserves, the consolidated profit and loss, in this case is coming to be the same. We will also study what happens post acquisition, but it is coming to be 500 only. And there is minorities interest. Where do we show minorities interest in the Schedule 3 balance sheet? You prepare the shareholders funds, share capital reserves, then a separate line item, point 2, minorities interest, then a separate line item, point 3, non-current liabilities, current liabilities, etc. And as a result, the minorities interest is 240. So these three numbers that I've written in blue will easily carry more than 60% of the marks of your overall question, and hence it is very important that you try to get these numbers correct. So over here, if we take 1500, 240, 700, 1800, so this comes to 4240 in the consolidated balance sheet. 2000, 500, 240 and 1500, this comes to 4240. This gives you the consolidated balance sheet from scratch. You will obviously prepare this in the Schedule 3 format. Now let us say what happens 1 year after acquisition. Let us say the parent company is a fairly lazy company, it does not do anything at all. So till 31st March 22, nothing changes in the parent company. However, the subsidiary does some work. A year later, 31st March 22, it earns another 100 rupees of profit. So over here, its P&L was 200 as on the date of acquisition. It increases by 100, and as a result, the question, this is how your exam questions will come. They will come a year later. Acquisition must have happened in 2011 or 2021, and you will be given the balance sheet on 31st March 22. Achha, but the balance sheet over here, obviously your P&L increases by 100. Your asset should also increase by 100, maybe land increases, maybe inventory increases, maybe cash increases. Let us say for simplicity, your cash increases by 100. What will happen? Over here, you have to prepare the consolidated balance sheet now. Let us say on 31st of March 2022. If you have to prepare a consolidated balance sheet 31st March 22, that is 1 year after the date of acquisition, still AS 21 will apply. You will take over assets and liabilities. Let us say the land. You will take that over 1500. Inventories, it is, for simplicity, it is the same, 500 and 200. Cash, it is slightly different. So this is, I guess, 1100 worth of cash. Loans are also the same. So this is, let us say for simplicity, this is 1900. Now what I want you to understand, or what I want you to tell me is, when I am going to prepare these notes, I will again start with the standalone parent on 31st March 2022, which is, by the way, 500 only. I will still start with the investment, which is 80%, which is 1200. You guys tell me, this is an investment which was made on 1st April 21. You should compare this with your share in the net worth on which date? Option A, 1st April 21, or option B, 31st March 22. You will compare the 1200 that you have paid on 1st April 21 with your share in the net worth on 1st April 21, option A, or 31st March 22, option B. Please tell me. That is absolutely right. You will take it on 1st of April 21. The reason over here being that 1200 is paid on 1st April 21. So you will look at the position on 1st April 21. Tata acquired Jaguar and Land Rover way back in 2007 or 2008. Now if I have to consider the goodwill, I will compare the investment that Tata made in 2007 against the net worth of JLR, Jaguar and Land Rover in 2007. Today we might be sitting in 2022. However, Tata had acquired a controlling stake in 2007. We will compare it with the net worth in 2007. Absolutely right. However, when we find the minorities interest is the share in the net assets. You have consolidated net assets of subsidiary as well as parent on 31st March 22, you guys tell me the minorities interest that you need to calculate is the minorities interest on option A 1st April 11 or option B 31st March 22. Minorities interest would be 31st March 22 because you are showing to the world that we have net assets today of the subsidiary worth, let's say, X amount, then minorities are 20% of that amount, and as a result over here when we do this workings, you will have the minorities interest appearing on 31st March 2022, which means we need to figure out what is to be done with the profits. The profits that are appearing, we prepare a working note number 4 on analysis of the P&L of the subsidiary. So over here we started with the balance on 1st April 21. The total amount for this was, I think, 200. During the year 21-22 there was some profits which I think was 100, and hence the balance on 31st March 22 came to be 300. Now you have to segregate these profits between pre-acquisition and post-acquisition. What do you guys think? What do you guys think? What are we trying to do? We are trying to analyze again. I think you want this again. So we are trying to analyze 300. AS 21 tells you, you consolidate assets and liabilities. You eliminate the investment against your share in the share capital and your share in the pre-acquisition profits. Institute also sometimes calls this as capital profits because this is prior to acquisition. However, what is to be done with the post-acquisition profits is what we are trying to study. We are trying to say that this 300 rupees that we see today, how do you analyze this 300 rupees? So this 300 rupees, 200 out of it has been earned when? Prior to the date of acquisition, that is 1st April 21, or after the date of acquisition, pre or post? $200 has been earned when? Prior to the date of acquisition or post? Pre, that is right. So this 200 is prior to the date of acquisition, you can put it in the pre column, whereas this 100 is earned in the year 21-22, which is prior to the date of acquisition or after the date of acquisition? Post, after the date of acquisition. So we have segregated it on a simplistic basis between pre-acquisition profits and post-acquisition profits. Remember, conceptually AS21 believes that pre-acquisition profits are purchased. You must have paid a PC for getting a share in them, whereas post-acquisition profits are earned. They are not purchased. You have put in the efforts, and because of which you are earning these profits after the date of acquisition. So what should happen with the pre-acquisition profits? We will try to find our share. There is P share is 80%, that is 160, and the minorities interest share is 20%, which is, let us say, 40. Where will this go? Well, this will be 160 will be adjusted against the investments in working note number 2. So over here in working note number 2, we will take the pre-acquisition profits at 160. Why? Because well, you must have paid, if this was 2000, then maybe 1200 में आपको नहीं मिलता था 80% से, you might have to pay 12,000. So we are trying to say that profits as on the date of acquisition, you purchase it, and for which you must have paid consideration in the form of investment. So we adjust it against the investment. Minorities interest 40, share in profits, which is already included over here. Minorities, they are not belonging to you, they are belonging to someone else. So whether it is pre or post, it is belonging to someone else. But the thing that we have not yet discussed is what happens to this 80 over here. 80 and 20. Again, 20 is attributable to minorities. It goes in working note 3. 40 is also attributable to minorities. It goes to working note 3. So this is, let us say, post acquisition profit and loss. Let us say another 20. So your minorities interest changes. Probably it becomes 260. Assets increase by 100. over what they were at the start of the year. Minorities get a 20% share in that 100. Your cash becomes more by 100, profit and loss increases by 100. So minorities also get a 20% share in that, that is 20 rupees, and hence minorities become 260. But my point is, you guys think and tell me, where should this 80 go? Should this also be adjusted against investment in order to calculate goodwill? Or should this go and get consolidated with the parent's reserves in order to find consolidated reserves? Option A, you adjust it to calculate goodwill. Option B, you add it to the consolidated reserves to find the total reserves. Option B. Why? Because these are reserves which are earned. This 80 is earned when you had control. You have not purchased this 80, you have spent your money, efforts, management time, and directed the subsidiary in such a way that it earns a profit of 100, and 80% of the profit is accrued, earned by you, and hence this will go in working note number 1. So you will take this as your share in post acquisition profits of S. Your share in the post acquisition profits of S, and the post acquisition profits of S are 80. So you take that, and hence your combined profits. Well, the parent has not done much, but the subsidiary has done some work, and you have 80% share in the subsidiary. So your combined reserves are 580. Your goodwill, once determined as on the date of acquisition, will not change. You have actually paid 1200 for getting a share in the net assets as on the date of acquisition worth 960, and hence your goodwill, once determined, will not really undergo a change. Your goodwill will continue to remain at 240 only, but the minorities' interest will keep on changing, because as the net assets increase, the minorities' interest increases. So how will the consolidated balance sheet on 31st March 22 be different? You will take the land, which is 1500, you will take the goodwill, which is still 240, you will take the inventories, which are 700, you will take cash, which is 1900, minorities' interest now will be 260, consolidated P&L will be 580. So you go to see the subsidiaries post acquisition profits increases by 100, out of which 20% share is to the minority, so this becomes 260, and 80% share goes to the parent, so this is 580, and as a result over here we will have 1500, 240, 700, 1900, this is 4340 on the asset side, 2000 plus 580 plus 260 plus 1500, 4340 on the liability side. Are we clear with this? Any problems here? Okay, so what we will do is, we will try to understand, I've shared, we'll try to understand the process and the steps. Remember, if you get the steps correct, and then we will discuss the adjustments in the second part. We'll also try a few problems. That's it in consolidation. It appears to be really daunting and challenging. It is not as challenging, honestly. It is just that it's slightly big, has some processes and steps. You get around it and it's sorted. So the features of full consolidation. First, when do you start consolidating? From the date you have more than 50% stake in the company, you continue consolidating till the time you don't give up that 50% stake, you don't lose control. So consolidation starts from the date the parent acquires control over the subsidiary and ends when the parent loses control over the subsidiary. So this is the timing. Second, all items of assets and liabilities, remember, not capital and reserves, assets and liabilities. All items of assets and liabilities incomes and expenses should be fully added, that is 100% on a line by line basis. This is irrespective of whether you have a 51% stake or a 100% stake. Third, so you have added all assets, all liabilities. What is remaining? Investment is remaining, share capital is remaining, and reserves are remaining. You will eliminate the parent's investment in the subsidiary against the parent's share in the subsidiary's net assets as on the date of acquisition. That can be, net assets are also net worth, that can be calculated as equity share capital plus the pre-acquisition reserves. Why are we comparing net assets with net worth? Because most of the institute's problems will give you an acquisition date of 21 and the balance sheet on 31st March 22. So you don't have the net assets on 21. However, you have the reserves on 21 and hence you can use that to back calculate the net worth. The difference, if any, on such elimination would be shown as goodwill or capital reserve. Like in our example, 240 was the goodwill or capital reserve. We can prepare the cost of control account for the above workings. Alternatively, we can also prepare a statement showing the above workings, whatever is comfortable. Fourth, the birthplace of minority. The share in the subsidiary's net assets which is not attributable to the parent should be shown as minorities. Minorities can be calculated using the proportionate net assets method. Net assets of a subsidiary can be calculated as assets minus liabilities or share capital plus reserves, and minorities will be an X% of the share capital. In our example, 20% of the share capital plus 20% of reserves, both pre and post. What is minorities holding? That is 100% minus parents holding, so 100% minus 80% will give you minorities. Again, minorities interest can be calculated by preparing the ledger account or by preparing a statement, as the case may be. Point 5. Reserves of the subsidiary need to be analyzed between pre-acquisition and post-acquisition. So the thumb rule is, what do you do with assets and liabilities? You consolidate them 100% line by line. What do you do with investment and share capital of the subsidiary? You eliminate them. And create a goodwill. What do you do with P&L? You basically analyze it. You don't blindly consolidate it because only the post-acquisition profit will be consolidated. You don't blindly eliminate it because only the pre-acquisition profit will be eliminated. Okay, so the reserves of the subsidiary need to be analyzed between pre and post and then should be attributable between parent and minorities proportionately. The parent's share in the pre-acquisition reserves is adjusted against the cost of control. Like in our case, 160 that we calculated was adjusted against the cost of control, as the parent would have paid a consideration in the form of investment in order to acquire those reserves. However, the parent's share in the post-acquisition reserve should be added while calculating the consolidated reserves, as there are profits which are earned during the period when the parent was in control. So basically, long story short, pre-acquisition profits parent share against the goodwill workings, post-acquisition profits parent share will be consolidated. ICAI sometimes calls the pre-acquisition profits as capital profits, whereas post-acquisition profits is referred to as revenue profits. Now, what are the steps in a consolidation process? I prefer that you follow the below steps. Remember, your paper is 100 marks and you have to solve it in 3 hours, that is 180 minutes. That roughly leaves you with 1.8 minutes per mark. So if a consolidation question comes for, let's say, 15 marks, then 15 into 1.8, this should ideally get over in 27 minutes plus or minus at max 30 minutes. So how do you time it? How do you lay down the process? So over here you read the question. Based on that, you prepare the Schedule 3 format balance sheet. I hope you are aware on how to prepare the Schedule 3 format. You don't need to write all the line items, you need to write only those line items which are there in the question. Additionally, you will write 2 separate line items, one is goodwill and one is minorities interest. Goodwill will appear along with intangible assets in the non-current asset section, whereas your minorities interest will appear as a separate line item after shareholders funds and before non-current liabilities. After you prepare the format, prepare consolidation notes where you prepare all assets and all liabilities, like land for parent, for subsidiary. Leave a couple of lines. Then let us say you have inventory, parent, subsidiary, leave a couple of lines. debtors, parent, subsidiary, leave a couple of lines and so on. Whatever assets and liabilities are there, you will put that down, except for investment in subsidiary, except for share capital of parent, except for share capital of subsidiary, reserves of parent, reserves of subsidiary, except for these 5 items, you will take everything. So all assets and all liabilities appearing in the balance sheet of both parent and subsidiary before making any adjustments. Adjustments is something that we will study, should be taken individually. We should not take the following items in the working. Investment in subsidiary, why? This will go in working note 2 for goodwill determination. Equity share capital of the parent and subsidiary. Equity capital of the parent will be separately shown. Subsidiary's equity capital will be eliminated. 70% of it will go to the cost of control. The remaining 20 or 30% will go to minorities. Reserves of the parent and subsidiary. Parent's reserves will be shown in working note number 1. I know this sounds too much, but if you just do some basic practice, this will flow through very easily. And subsidiary reserves need to be analyzed. Analyze means you have to bifurcate them first between pre and post and then between parent and minorities. A separate note needs to be prepared for the equity share capital, which represents share capital of the parent only. Okay. Then you prepare 3 working notes. These working notes will roughly take 1/3 of the side each. Consolidated reserves, where you start with standalone reserves from P's balance sheet, to which you will add the share in the post reserves, which you will later calculate for the subsidiary. Then working note 2, which is cost of control. Here I have shown this in ledger format. You can obviously make this in the statement format like we did. In fact, Institute does this in the statement format, so that is okay. You will start with the investments and then adjust the share capital, pre-acquisition reserves, and minorities interest, which is again either in the ledger format or in the statement format, where you would take 20%, let us say, as equity share capital. Then going to the most important step, which is analysis of reserves, working note number 4. Within that, you will note down what the reserves are for the subsidiary, bifurcated between pre and post. Let us assume for the timing there are no adjustments. If there are no adjustments, you bifurcate it between pre and post, and whatever the reserves are will be attributable to the parents and minorities. The parent share in the pre-acquisition reserves will be adjusted against goodwill. Parent share in the post-acquisition reserves will be going in the consolidated profit and loss. For minorities, whether it is pre or post, it will go to the minorities interest working. Once you have given all of these effects, you will give effect to other consolidation adjustments, like there may be common debtors and creditors. In the parent's books, subsidiary would be a debtor. In the subsidiary's books, parent might be a creditor. You will eliminate it. And after all adjustments are done, the balance all the 3 workings, total up the items of assets and liabilities, and then give the postings in the final balance sheet. So this is your total step-wise working for preparing a consolidation question. If the parent originally had an 80% stake and it acquires another 15% stake, again it is called as a step-up acquisition, though in inter se a step-up acquisition does not come, so you don't need to bother. Again, for that 15% stake, you will have to calculate goodwill, you will have to find the share in the 15% reserves, etc. However, at inter se level, the institute does not ask you such questions. It is for a single subsidiary at a single stake purchase, so you don't really need to bother too much on that lines. Okay. So over here, what we can try to do is, we can try to do a fairly basic question from the question bank. This is a concept builder question, just to acquaint you and kind of prepare you in understanding. Obviously, we are not going to solve it from scratch at length. I mean, we're trying to ingrain the concept in your mind. We are not going to solve it from scratch, but I hope this at least gives you perspective. So let us say we go to question number 1. From the following data, determine in each case, you can focus on the screen, the minorities interest. This is, I think, even illustration 1 of your study material, at the date of acquisition and at the date of consolidation, goodwill or capital reserve, the amount of holding company's profits in the consolidated balance sheet, assuming the holding company's own profit and loss is 2 lakhs in each case. And then there are 4 cases, 1, 2, 3, 4, subsidiaries A, B, C, D, percentage shares old, 90, 85, 80 and 100. You have the cost in each different cases. The date of acquisitions are 1st January 16 and the date of consolidation is 1 year later, that is 31st December 16. You have been given the share capital and the profit and loss balance, share capital and the profit and loss balance. So your share capital, if you go to see over here, remains the same, 1 lakh and 1 lakh, 1 lakh and 1 lakh, 50 and 50, 50 and 50. So there's no change in the share capital, but there must be certain profits. So there might be certain profits. These are profits during the year 2016. So if I go to see, this is 50,000 and 70,000. So this is, let us say, 20,000 worth of profit during the year. This is 30,000 and 20,000. So that's a negative. 10,000, that's a loss during the year. 20 and 20, so that is no profit, no loss. And at the end, that is 40 and 55. So appears to be a 15,000 profit during the year. Now, how are we going to solve this question? Well, we don't have to prepare consolidated balance sheet as such over here, but this is a question where we do some practice. Just a second, I'll just charge my pencil a little. This is a question where we will try to prepare the 3 working notes. So there's working note number 1, which is on reserves, working note number 2, which is on goodwill, working note number 3, which is on minorities, and then the share in profits, which you have to find. So over here, if we get one case properly, or probably the 2 cases properly, we will be able to solve for the other cases as well. Okay? So let us try to prepare the statement. Just a second. Okay. So over here, let us say there is working note number 1. We can go in any order. So this is your consolidated P&L. I'm just writing it in rough. So this is case 1, case 2, case 3, case 4. In either cases, you will start with the standalone parent. Parent standalone, the question tells you, is 2 lakhs. Maybe in practice you leave around 8 to 10 lines. There are not enough adjustments over here. And then you go to the statement for the goodwill determination. Goodwill / capital reserve determination. Again case 1, where I think you are acquiring 90, then 85, then 80. That's 90% stake. Case 2, 85% stake. Case 3, 80, and lastly 100. Case 4, 100. Okay, you will start this working always by investment. How much is the investment that we are making in case 1? Well, we are making an investment of 1,40,000. Against this investment, what are we getting? Well, we are getting a share in the net worth. How much share in the net worth? Well, equity share capital. If equity share capital of the subsidiary is 1 lakh, this gives me a 90% share, and hence this is 90,000. But the remaining 20% is attributable to whom? Well, it is attributable to a minorities interest, which again case 1, case 2, case 3 and case 4. In case 1, the minorities is 10%, parent owns 90, the remaining 10 is held. Case 2, this is 15%, case 3 is 20%, and case 4 is 0%. So we can say 20% of the equity share capital, 10% of the equity share capital, 1 lakh into 10%, that is 10,000, is attributable to the minorities. So this is, let us say, attributable to the minorities. Now what you are left with really is the profits. Everything else you have kind of considered. So when we try to find the profits, your share in the profits, let us say, of A, the profits of A pre-acquisition and post-acquisition, and then you will have to attribute it between parent and the non-controlling interest. So how much is the profits pre-acquisition? If we go to C, 50, and then it becomes 70. So if I were to look at A, my total profits, then pre and post, my balance on 1st April, what? Or 1st January, 16 is 50,000, and my balance on 31st December 16 is 70,000. That means profits for the year 2016 are 20,000. 50,000 was earned prior to the date of acquisition, whereas 20,000 was earned after the date of acquisition. There are no other adjustments. So 50 and 20. This 50, 80% is attributable to the parent. No, sorry, in this case 90% is attributable to the parent. 10% is attributable to the minorities. So over here 50,000 ka 90% is 45,000 attributable to the parent. 20,000 ka 90%, which is 18,000, is attributable to the parent, whereas to the minorities 10%, which is 5,000, is attributable to the minorities. 2,000, which is also attributable to the minorities. Where will the 45,000 go as a process? 45,000 will go towards your goodwill working. So this is pre profit and loss, 45,000. Pre profit and loss will also be attributable to the minorities, which is worth 5,000. Which is worth 5,000. 18,000 is going to be added in the consolidated reserves. So this is plus share in post profits of subsidiary, share in post profits, let us say 18,000, and the remaining 2,000 is attributable to minorities, which is the post profit and loss, let us say 2,000. So this takes care of all the workings, and hence you can say 2,18,000 is the consolidated P&L as on 31st of December 2016. Your total net worth, let us say if investment is A, total net worth is 1,35,000, which is B. The difference between the two, goodwill if positive, A minus B, capital reserve if negative, A minus B. So this is 1,40,000 you are paying for something which is worth 1,35,000, and hence 5,000 is the goodwill. Minorities interest, the question tells you to calculate, this question tells you to calculate the minorities interest as on the date of acquisition. So the balance of minorities interest on 1st January 16 is actually 15,000, and later there is a 20,000 profit in which the minorities get a 2,000 share, and hence the balance on 31st December 16 comes to 17,000. Are we understanding this? So if we do case 2, and if we get case 2 properly, 3 and 4 are just going to go in a similar fashion. So case 2 as well, you will start with the profits at 2 lakhs. The investment that is happening in case 2 is 1,04,000. So your investment over here is 1,04,000. You will put that in the working. You will eliminate the share capital, which is worth 1 lakh. So out of 1 lakh, 80% stake now. So against the 1 lakh, 80% stake is attributable. So that is 80,000. 20% stake over here. So this is 20,000. And then we will try to find the profits. Over here, when we look at B, B's total profits at the start of the period is 30. The losses during the period is 10, and hence this is 20. Out of this, you will segregate between pre and post. Within this, in the pre section, 30,000 will be entirely pre, 10,000 will be entirely post. So this is 30 and 10, within which you will allocate this to the parent 80%. So this is 24,000. This is, I think, 8,000 negative. To the minorities, 6,000, 2,000 negative. And as a result, we will allocate this 24,000 over here in the goodwill workings. 6,000 will go to the minorities. Negative 8,000 is your share in the post acquisition reserves, and negative 2000 is your share in the post acquisition P&L. So this will give you 1,92,000. The total net worth I think is also 1,04,000, which means there is no goodwill, no capital reserve over here. 26,000 and less 2,000, which is 24,000. Do you want me to try case 3 and 4, or is it understandable? Okay, so this is absolute basics. You can even refer the same sum that is there in the study material as well. Now when we proceed further in consolidation, there are two parts of consolidation actually. If you were to prepare the consolidated balance sheet, there can also be questions of consolidated P&L, and we will study that as well. But first, the more tricky part, the elephant in the room, the big part is the consolidated balance sheet. Now when we are looking at consolidated balance sheet, you first need to be accustomed with the process that we have done, and second is key adjustments. So there are around 8 or 9 adjustments, out of which 2 or 3 are very important, and institute just mixes and matches those adjustments, which is what you have to be very careful while you are preparing the working note 4 on analysis of profit and loss. If you are able to tackle these adjustments, consolidation is in your pocket, you don't need to worry. Now what are these adjustments? First, it is possible that the minorities' interest turn negative. Can they be negative? You need to see that. Second is, you might be given the fair values of assets and liabilities as on the date of acquisition. How will you do the workings if the fair values are given? A very important adjustment. Third, it might happen that even after acquisition, parent and subsidiary do some transactions where parent sells goods to the subsidiaries, subsidiary sells goods to the parent. These are called as intercompany transactions, upstream or downstream transactions. Again important, we have marked that. Fourth is the dividend adjustment, where subsidiary might be paying dividend, maybe out of pre-acquisition profits, maybe out of post-acquisition profits. What to do when there is capital reserve? Well, nothing, you just show the capital reserve along with your reserves and surplus. If there is a capital reserve, I think in case 3 you did have a capital reserve, in which case you will, whatever is a capital reserve will be shown along with the reserves and surplus, nothing else. Dividend adjustment. So the 3 most important adjustments are the fair value adjustment, the unrealized profit on upstream or downstream adjustment, and the dividend paid by the subsidiary adjustment. These are the most important adjustments. Next, you have preference share capital, bonus, not very important, they don't come as often, uniform accounting policies or different reporting dates. So, and there is some alternative method to calculate goodwill and capital reserve and consolidated profit and loss account. So, if you get your arms around these adjustments, you are by and large sorted. There are few very easy adjustments, and we will first try to discuss them and get them out of the way first, so we can channelize and focus our energy over the course on the 3 really crucial adjustments. First is the negative minorities. Minorities interest, do you think, like in this question, you had a loss, right? So 26,000 was your minorities, it was reduced by 2,000 and it becomes 24,000. My point is, sometimes you might suffer huge losses. I'm just charging my pencil for some time, I'm sorry. You might see a blank screen. Sometimes there might be really huge losses. What do you guys think? If there are some really huge losses, minorities interest, let's say 26,000 was my opening balance and the share of losses of minorities interest is 30,000. Let us say the share is 30,000. Your total losses are 3 lakhs and minorities interest share is 30,000. What do you guys think? Can we show minorities interest having a negative or debit balance, as the case may be? What is your opinion? Can minorities interest be shown as negative or debit balance? The answer is no. you cannot show them as negative. In fact, you will restrict them to 0. We will say that as per the limited liability concept, beyond the share, you cannot force minorities to pay anything over and above that. So one can say that, okay, if the net assets were 1000, 1000 into 20%, that is 200, is something that I owe to the minorities. I will give to the minorities. However, if let us say the amount comes to be negative and the shares are fully paid, can I go and tell the minorities to give me anything for the losses? No. And as a result, if I show a debit balance, that implicitly means that I am telling that money is receivable from the minorities. Can I legally recover money from the minorities? No. Beyond their share, no. And as a result, minorities' interest will be restricted to 0. Any share beyond their balance, once it reaches 0, will be ignored. At best, it can be allocated to the majority shareholders. So this is minorities' interest. There is a question in the institute study material as well on this. It is not a full-fledged question, but I would recommend that you refer that question. The principles that you remember is minorities' interest cannot go to be debit or negative. It will be restricted to 0. In case 26,000 was your balance and 30,000 is your share of loss as a minority, then 4,000 is the excess loss. This excess loss is to be borne by the parent. Why? Because typically parent wants the subsidiary to continue. A lot of times in practice, parent also gives guarantees for the loans or liabilities that are taken by the subsidiaries, and hence as a going concern assumption, the losses, if the minorities is not giving any money, the parent will have to kind of bear those losses. That is what the institute assumes in the going concern. So the share of losses will be borne by the parent. It will keep on bearing the losses. If there is a profit, this profit will first be taken by the parent to the extent of losses which it had borne for the minorities, and after that, once those losses are compensated, we will record a profit. This is something which is a very special case. I'm just discussing broad theory over here. For you to better understand this, you will have to solve a sum which is there in the institute study material. You will not get a full-fledged consolidated balance sheet question on this, but there is a possibility you might get a 5 or a 6 mark question which is only pertaining to the negative minority interest concept, and I would strongly recommend that you refer that question of the study material to just check on how the balances progress as the minority becomes 0. How do you allocate the loss to the parent? Once you start earning profit, how do you reduce that? Like in income tax, you have a carry forward loss. Once you start having profits, the profits are first adjusted from the carry forward loss, and after that it comes as a part of taxable profit, something like this. I'm just giving you a brief overview, but I would want you to refer the institute study material for this. We will do full-fledged questions on fair value adjustments, upstream, downstream, dividend, etc. But due to constraints of time, we would probably just discuss the negative minorities over here. You can just refer that concept. Acha. Fair value adjustments. What do you mean by a fair value adjustment? Now, have you guys studied AS 14 amalgamation? Have you guys studied AS 14? Yes. In amalgamation, you take over assets and liabilities of the selling company. You take them over at what value? At fair value or at book values? Usually. Fair value. Sorry, you will take them over at fair value. Amalgamation is a way in which you acquire a business, you close the other company and take over the assets and liabilities. However, legally, consolidation does the same objective. Over here, it is possible that Tata Motors Limited might acquire 100% share in a company called as Jaguar and Land Rover Limited. Now Tata Motors might decide to close Jaguar and Land Rover and amalgamate Jaguar and Land Rover's business with Tata Motors, in which case which accounting standard will apply? AS 14, amalgamation and absorption. Whereas Tata Motors might say that, well, I can continue to keep JLR alive as a separate legal entity. However, by virtue of my 100% stake, I can decide what I want to do with JLR. And as a result, in this case, JLR continues as a separate legal entity. There is no amalgamation, there is no absorption. However, there is consolidation. So in this case, AS 21 applies. However, if I am Mr. Ratan Tata, then for me, the legal structure does not matter. At the end of the day, JLR and Tata Motors are one and the same. So even over here, JLR and Tata Motors in substance are one and the same. So as you guys have rightly said, that JLR or Jaguar and Land Rover's assets and liabilities should be taken over by Tata Motors at fair value. Jaguar and Land Rover's assets and liabilities should be taken over by Tata Motors at fair value. Well, whether it is amalgamation AS 14 or it is consolidation AS 21, these assets and liabilities have to be taken over at fair value only. Does this make logical sense? Should you take over the assets and liabilities at fair value only? Yes. Why should you take it over, and why do you need to separately do an adjustment? Let us say this is Jaguar and Land Rover JLR. JLR on 1st April 21, let us say, had land which was worth 100. The fair value of this land was, let us say, 500. Equity share capital worth, let us say, 200, or rather equity share capital worth, let us say, 10, and a P&L balance of, let us say, 90. Now Tata Motors goes to the shareholders of JLR, which was earlier Ford, and from the shareholders of JLR, Tata Motors acquires 100% stake in JLR. If Tata Motors on 1st April 21, Tata Motors Limited acquires 100% in Jaguar and Land Rover JLR by paying, let us say, 500. In which case, if I look at Tata Motors Limited balance sheet, I will show an investment in Jaguar and Land Rover JLR worth 500 rupees. Okay. Now, if I don't do any adjustments for fair value, what will wrongly happen is, I will start preparing the assets and liabilities. In that, let us say you will have Tata Motors Limited, you will have Jaguar and Land Rover Limited, and you will show land. Let us say Tata Motors does not have any land. Jaguar in its individual books, Jaguar continues as a separate legal entity, will show the land at 100 only. Remember, for Jaguar, what has happened in reality is when Tata Motors acquires 100% stake, Jaguar के individual books में कोई भी change नहीं है. There is no change. Why? Because in stock market as well, shares keep on changing daily. For Jaguar, when Tata acquires 100% stake, only its register of member changes. In its register of members, we earlier had the name of Ford Motors. Now instead of Ford Motors, you have Tata Motors. Other than that, Jaguar continues to be a separate legal entity. Let us say if accounting standard 10, AS 10 on fixed assets will apply, Jaguar is not going to revalue land in its books merely because Tata Motors has acquired a 100% stake, and hence JLR in its books will continue to show the land at 100 rupees only. Okay. If I make no adjustments, then total in my consolidated balance sheet, I will see 100 rupees as my consolidated land. Separately, when I prepare my working note number 2, I will start with the investments. The investment that Tata Motors has made in JLR, for example, is 500. This will be adjusted against Tata Motors share in the net worth or net assets, let us say, which is 100%. So over here, equity share capital of JLR is 10. Tata Motors has 100% stake, so the entire 10, and the profit and loss that JLR has, the pre-profit and loss is, let us say, 90. Tata Motors has 100% stake, so pre-profit and loss as on the date of acquisition is also 90, and as a result the net worth of JLR is 100. For something which is worth 100, Tata Motors is paying 500, and as a result 400 appears as what? Can you guys tell me this 400 appears as what? Please answer. What do you think this 400 appears? In the method, if you don't do any adjustment, it will appear as goodwill. Is this correct? Should this appear as goodwill? If it does, in my consolidated balance sheet, land is appearing at 100, goodwill is appearing at 400. Is this showing a correct picture? Capital reserve to nahi hai, it is goodwill. For something which is worth 100, you are paying 500, so it appears to be goodwill. But my question to you is this showing the right picture? JLR had land which is worth 100 in its books, but the fair value of this land was 500. Tata Motors acquired 100% stake in JLR by paying 500 rupees, and hence we are showing to the world that we got land worth 100 and we paid a premium goodwill for JLR's business which is worth 400. Is that a correct picture? No, it is not. Why is it not? The excess of 400 that you are paying is not for the reputation, brand name or goodwill of JLR. It is because the land of JLR is actually worth 500. So here when the reader reads the financial statements, he is wondering, "Arey yaar, 400 you have paid for goodwill." Well, you have not paid 400 for goodwill. You have paid the 400 excess because the land is worth 500. Well, JLR does not revalue the land. Probably as per AS10 it is following the cost model, and hence JLR does not revalue the land. But that does not mean that the land is only worth 100. The land is worth 500, and as a result you will have to pass certain adjusting entries. So when we are preparing, is it compulsory to pass the entry? Not at all. However, I prefer passing it. Institute does not do it. Institute does directly gives the effect. We will also give the effect, but passing an entry makes it a little more easier. So when we are analyzing the profit and loss, let us say of Jaguar and Land Rover, we will take the balance. Let us say the balance is on 1st of April 2011, total for 21 total, then pre-profits, post-profits. Over here, let us say the balance was 90 rupees plus profits, there are none, and let us say you get the balance. Let us say we are still sitting on 1st April 21 only, which is worth 90. This 90 is entirely there as on the date of acquisition, pre-profits. Now, what about the adjustments? This 90 is belonging to the parent, perfect. However, you have to increase the land. If you have to increase the land, you have to debit the land. So land will be debited by how much? Yes, this is due to fair value change. Which mode of valuation? Well, that is depending on the valuers. So land is debited by 400. Where will the second effect go? This appreciation belongs to whom? Well, this appreciation belongs to owners. Typically, it will go to the revaluation reserve or a fair value reserve. For the purpose of consolidation, we don't really bother with what name the reserve is. We bother with where the reserve should go. Should it go along with consolidated reserves in working note number 1? That is, if it is post acquisition, it will go in working note number 1. Or should it go along with goodwill workings, where investment is going, in working note number 2? That is the goodwill working, where it goes in working note number 2. You guys tell me, whatever be the name of the reserve, you can call it as revaluation, profit and loss, anything. It belongs to the shareholders. Is this reserve, is this profit of 400 accruing prior to the date of acquisition? Is it due to an increase in fair value prior to the date of acquisition, or is it after the date of acquisition? What do you guys think? Is this prior to the date of acquisition or after the date of acquisition? Well, this profit has arisen prior to the date of acquisition. How? Well, JLR must have acquired this land maybe in 2005, maybe in 2010, and today when we are sitting in 2021, this land is worth 500. So this 400 appreciation must have occurred prior to the date of acquisition, and as a result, this is pre-acquisition profit. So this is pre-profits. And where do pre-profits ultimately go? Where pre-profits ultimately go to the investment or goodwill working. So over here, Institute says you can directly adjust it against pre-P&L. If you don't like to do it against pre-P&L, you can adjust it against the revaluation or any other reserve. It does not really matter, because at the end of the day, because it is pre-acquisition profits, you will be adjusting it in the goodwill workings. It will not appear in the final balance sheet. So the two effects, your land will be debited by 400. So in your adjustments, you will increase land by 400, and hence your land will appear at 500. And second, in the pre-acquisition profits, there will be a fair value adjustment. A fair value adjustment where you will increase your profits by 400. Well, by the way, these are profits prior to the date of acquisition, and hence this becomes 490. If this is 490, this 490 will be attributable both to the parent, and if there was any minorities interest, some of it will also be attributable to the minorities interest. Now, what will it ultimately do? When I take this, we will take this in working note number 2, where we are doing the goodwill workings, in which case instead of taking 90, we will take 490. In which case over here you will have 10 plus 490, which is worth 500, and hence the goodwill is 0, because you are actually not paying any premium. In reality, you are paying 500 for a business which has land worth 500. So for something which is worth 500, you are paying 500. So you are not really excess paying anything. So there is no goodwill, and the land should appear at 500. Now the land appears at 500. So if I now try to prepare the consolidated balance sheet, this is at 500, whereas goodwill is 0. Does this give a better picture? In my consolidated balance sheet, my land should be appearing at 500, my goodwill should be appearing as 0, which is the case. Now, why did we have to do all of these adjustments? The root cause of this problem is when parent acquires 100% stake in the subsidiary, there is no requirement that the subsidiary has to remeasure its assets and liabilities, which means the subsidiary can continue to show its assets and liabilities as per its existing values. It is just change in the shareholding for the subsidiary, and hence AS10, if you have studied in your paper number 1, well, you don't need to revalue assets and liabilities in JLR's books. However, when Tata Motors acquires, in order to truly calculate the goodwill properly, it has to take over the assets and liabilities at fair value as on the acquisition date, and hence we will have to do this adjustment, the fair value adjustment. Achha, this is the fair value adjustment as on the date of acquisition, but it is possible that the question gives you the position not as on the date of acquisition, but let us say 1 year after the date of acquisition. So let us say in this question we modify it a little, and let us say we go to 31st of March 2022. So if you are on 31st March 2022, and let us say this is not land, let us say this is building, and this building, let us say you were given that on 1st April 21, that is date of acquisition, building had WDV of, let us say 100, fair value of 500, and useful life of 10 years. Building had a useful life of 10 years, which means 1 year later, what do you guys think? Would the building have been depreciated? Well, yes, and hence in your books, JLR would not care what the fair value as on the date of acquisition was. It would have said 100 minus 10, and hence the building would be appearing at 90 rupees. Acha, in the profit and loss, 1 year has passed by, and as a result, some profits might have been earned. So this is 90 plus, let us say, cash profits that you might have earned of, let us say 120 rupees minus 10 rupees, let us say is the depreciation on the building during the period, and hence this is what, 90 plus 120 minus 10, so this is, let's say 200 rupees. So you have earned a profit of 110, let us say post acquisition, in which case this is coming to 200, and let us say this profit is in the form of cash of 110, let us say. Now this is the position on 31st of March 2022, 1 year later. A couple of things we need to understand. If I prepare my consolidated balance sheet, let us say on 31st of March 2022, we will start with buildings. Buildings over here, you guys tell me, what is a building appearing in the Tata Motor, in the Jaguar balance sheet? Now on 31st March 22, what is a building appearing in Jaguar's balance sheet? Well, the building is appearing at 90. Okay. When we do the working, we will still take the investment. Achha, apart from that, obviously there is cash now, which is worth, let us say 110. We will try to do the goodwill working, in which case the investment is still 500. You still have a 10%, 100% share in the equity share capital, but we want to find the profits. Now the profits to start with are 1st April 21 profits, then there is a profit of the year 21-22, and then 31st March 2022. We can see this is now 200 rupees, which means 110 is earned post acquisition. This is 110 post acquisition, and hence 110 is the post profit. Acha, as a matter of fact, you are 1 year after the date of acquisition. However, you have started from the standalone financial statements, and as a result, building is still appearing at 90. If you do nothing, the building in my final balance sheet will continue to appear at 90. You guys tell me, is that correct? In the consolidated balance sheet, should the building appear at 90? No, the building over here should appear at the based on the fair value and then subsequent depreciation, and hence we will still have to pass this adjusting entry, that is building account debit. As on the date of acquisition, the building was worth 500 when the WDV was 100, and hence the building has to be increased by 400. This increase was prior to the date of acquisition, and hence this 400 will increase the pre-acquisition profits, which you have already done. My question to you is there any other adjustment that is needed? Think through. So this 400 will still come, so you will still add this 400, and the building will now be 90 plus 400. My question to you is there any other adjustment? Well, yes, there is depreciation. Why? Well, because if you are telling the world that your building is worth 500, then your depreciation should also be based on 500. What has happened over here is, in your books, in JLR, separate or standalone financial statements, the depreciation that they have recorded is 100 divided by 10, that is 10, and that 10 rupees has already been recorded, but that is based on the book value. In the CFS, you are showing the asset to be worth 500 at the start of the year, so your ideal depreciation should be 500 divided by 10, which is 50. So should you record a depreciation for 50? This is depreciation for the year 21-22. This is depreciation for the year 21-22. You have recorded a depreciation of 10, ideally it should be 50, and hence there has to be an additional depreciation. This is additional depreciation for which period? Well, this is 21-22 of 40 rupees. This is a period post acquisition. Depreciation and additional depreciation reduces your profits, and hence if I were to pass entry, it is not mandatory, but the entry would be depreciation, which is going to reduce the post acquisition profits of the subsidiary. Account debit to the building. How much will that be? 40. Why should this come? Well, over here there will be less additional depreciation. Additional depreciation worth 40, less karege, one effect. Remember, adjustments you have to give two effects. The second effect will come over here, again less 40, which means your closing asset will become 90 plus 400 minus 40, which will come to 450 rupees. So this will, let us say, come to 450 rupees. Okay. Should this be 450? The answer is yes. Your opening fair value in the consolidated accounts was 500 and the depreciation on that was 50, and hence your closing has to be 450 rupees. There is no other adjustment required. Your closing has to be 450, and that is absolutely right. Okay. Now, why should your profits reduce by 40? Because you are telling the world that in the post acquisition period you made 120 minus 10, that is 110 rupees. As you can see, you are telling the world that I have made 110, but 110 is calculated after taking a depreciation of only 10 rupees. Ideally, if you are showing the assets in your balance sheet at 500, the depreciation should not be 10, it should be 50, and hence you are adjusting the additional depreciation, and hence this will come to 70. Achha, this 70 will be belonging to the parent only, and hence that will go to working note number 1. So, your working, if you go to see, 490 still goes in the goodwill working, and hence the goodwill still is 0, which is absolutely right. And when you are calculating the reserves in working note number 1, you start with the standalone parent, and to that you add the post profits of Jaguar and Land Rover, which is 70. It appears that they have earned 110, but that is after considering only 10 of depreciation. If you are telling the reader that 500 is the asset, your depreciation is 50, and hence the additional 40 has to be adjusted, and hence 70 will go over here. Are we clear with this? In my consolidated balance sheet, my land, in this case let us say my building, will appear 1 year later at 450, goodwill will still appear at 0 rupees, and my share in profit along with the parent's profits will be at 70. Okay, so this is a very important adjustment, a fair value adjustment. Even at final CA this adjustment comes a lot. We'll just read all the important adjustments at least. As per AS 21, the assets and liabilities of the selling company should be taken over at fair values as on the acquisition date. Okay, you don't have to remeasure it at fair value at each balance sheet date, but you have to at least take them over at fair value, exactly similar to what you would have done in AS 14 as well. In case the fair values are not given, the book values can be assumed to be the same as the fair values. Okay. However, in case the fair values on the acquisition date are separately given, we need to make certain fair value adjustments at the time of consolidation. If they are given, we will make certain fair value adjustments at the time of consolidation, like we have done the adjustment for 400 and the additional 40. This is because it is not mandatory for the subsidiary to revalue its assets in the standalone books merely because parent is attributing a higher or a lower value on the acquisition date. Therefore, unless specifically given, we would always assume that the subsidiary has not revalued its assets in the standalone books, तो 90 पे दिखेगा. However, in the consolidated accounts, the assets have to be shown based on the fair values as on the acquisition date, and hence the following adjustments are needed. Property, plant and equipment. Initially, you take the difference between fair value and the WDV. In our example, 500 minus 100, that is equal to 400. If that's an upward movement, that is PP account debit to pre-reserves. Even if it's a downward movement, in this case we had taken the example of upward, then pre-reserves will be debited, PP will be credited. So if 100 was the carrying value and you are taking it over at, let's say, 60, then 40 is the downward movement. Again, that was a reduction prior to the date of acquisition, will be adjusted against the pre-reserves. The name does not really matter, it will go against pre. Subsequent adjustment will be the impact on depreciation. You will find a depreciation based on fair value, which in our example was 50, depreciation based on WDV, which in our example was 10, and hence 40 is the additional depreciation. If there is an additional depreciation, then it will reduce the profits, but this is depreciation for a period after the date of acquisition and hence post. On the other hand, if there is a reversal in depreciation, you will have PP to post reserves, post reserves gets credited, and hence the depreciation adjustment over here. Okay. The general rule, initial changes in fair value will always go to the pre-reserves as it reflects the changes that have already happened till the date of acquisition. So this is referring to adjustments over here. Any subsequent events like depreciation would always be adjusted against post reserves, as the change in the depreciation will happen after remeasurement is done on the acquisition date, and hence the additional depreciation will arise post acquisition and hence should be adjusted in the post period. So basically, depreciation adjustment will be against the post profits, but the fair value adjustment will be against the pre-profits. Now this is a working that you do in case of a fair value adjustment. There is also another adjustment which involves unrealized profit on upstream or downstream inventory. This is relatively easier. We will do a full-fledged problem as well. I think 1 or 2 problems depending on the time in tomorrow's class for applying this adjustment. We have just discussed the theory. You can go through and probably settle this down and then we can apply it. Second adjustment is the upstream or downstream adjustment. So over here what happens is parent can sell goods to the subsidiary. Let's say the cost price of the goods to the parent is 100 and the parent can sell it, let us say, for 120, in which case there is a profit. This profit is 20, which is recorded in the books of the parent. The subsidiary might actually sell these goods to outsiders, in which case there is no stock lying in the books of the subsidiary. However, if subsidiary is unable to sell this to an outsider, then the goods are lying in the books of the subsidiary at 120, which is correct because subsidiary has purchased it from the parent at 120 and as per AS2 you will record the inventory at cost. However, that is right for subsidiaries individual books. When I prepare consolidated accounts, what will happen is when I prepare the notes of PS, let us say adjustments and total, I would say that the inventory over here, let's say P does not have any inventory, subsidiary's inventory will be 120 and if I do no adjustment, my total inventory will appear at 120. Similarly, when I prepare a working note number 1 where I prepare consolidated reserves, I will start with standalone parent. And when I start with standalone parent, my standalone parent will show a 20 rupees profit. However, this is a profit on transacting with subsidiary, which is correct in the separate financial statements because subsidiary is a separate legal entity. However, in consolidation, can I earn a profit by transacting with my own self? No, parent and subsidiary is one and the same. So I don't really earn a profit by transacting with my own self. And as a result, to show this 20 as consolidated profit is wrong because it is on transacting with the subsidiary. Again, showing the inventory at 120 is wrong because for the group as a whole, inventory is recorded at cost, and for the group as a whole, the cost of the inventory is actually 100, not 120, and hence an adjusting entry will have to be passed. What is the adjusting entry? Well, you will debit the P&L of the parent by 20. Where is the P&L of the parent appearing? It is appearing as a part of your working note number 1. Basically, it is appearing in the consolidated P&L working note. You will credit, so you are eliminating the unrealized profit, and the second effect will go against the inventory. The second effect correspondingly will go against the inventory. So you reduce the inventory, let us say, by 20 rupees. What that will do is, this is called as a downstream transaction. Parent selling to subsidiary and subsidiary unable to sell it to anyone else. This is a downstream transaction whereby we are trying to say that if the parent is selling to the subsidiary, subsidiary is unable to sell it to an outsider, then there is some unrealized profit lying in the stock which is in the subsidiary's books. Subsidiary has no profit on this. It must have shown purchases of 120 and closing stock of 120. So it has neither profit nor loss, but parent must have shown purchases of 100 and sales of 120, and hence a profit of 20 would be appearing in the books of the parent. So over here, when we are looking at the subsidiaries financial statements, in the subsidiaries financial statements, I would have a 20 rupees. A 120 rupees stock in parents financial statements, 20 rupees profit. So over here I will reduce my inventory by 20 and hence my closing stock in my consolidated accounts appears at 100. At the same time, I will remove the unrealized profits in downstream transactions, and hence my overall profit continues to appear at 0, which is right. You have not done anything else, then there should be no additional profits. You guys tell me, if subsidiary sells to parent and the parent is unable to sell it to an outsider, this is called as an upstream transaction. The profit is in whose books? Can you guys tell me? The profit in this case is in whose books? Well, the profits are in the books of the subsidiary. The parent now recognizes the stock at 120. Now, when we are trying to find the assets and liabilities, let us say you take this note on assets and liabilities where you take P, S, adjustments and total. So, when we are looking at these assets and liabilities, let us say the inventories in the books of the parent appears at 120. Now, subsidiaries actually bought it for 100. So, for the group as a whole, if you think parent and subsidiary is one and the same, the real cost is 100. At the same time, when you look at the working note 1, standalone parent shows nothing. Let us say the parent has done nothing. It has just purchased goods worth 120, done no sales, that 120 is appearing in closing stock, nothing appears. This profit of 20 is appearing in the books of the subsidiary. Remember, the profit of the subsidiary is not just attributable to the parent, it is attributable to both the parent as well as the minorities' interest. And as a result, when we pass the adjusting entry over here, the adjusting entry will be P&L of the subsidiary account debit to inventory. Yes, we will very much reduce our inventory by 20, and hence the inventory for the group as a whole appears to be 100, which is perfect as per AS2. Your inventory is appearing at your overall cost, which is 100. However, the 20 of inventory appears in the books, 20 of profits appears in the books of the subsidiary, and the profits in the books of the subsidiary are attributable to both the parent and the minorities' interest. So, over here, when we do our analysis, we typically have the balance, let us say on 1st April 21, to which you will add the profits, let us say of the year 21-22. Now, and then that will give you the balance as on 31st March 22. So, typically what would have happened is you would have total profits. Let us say if this was the only transaction, then during the year you must have made a 20 rupee profit. This 20 rupee profit during the year, if the sale has happened, would be in the pre-period or post-period. Well, it will be in the post-period. However, this is not a true profit, and as a result, we will have to eliminate it. So, over here, you will eliminate the unrealized profit from upstream, and as a result, this will impact the parent and minorities both. In this case, 20 minus 20 becomes 0, but let us say subsidiary had other transactions as well, and hence its profits was, let us say, 220. Then ideally 220 would have gone 90% to the parent, 10% to the minorities. Now, instead of 220, only 200 will go 90% to the parent and 10% to the minorities, and hence minorities are also bearing a share in the unrealized loss, because, well, the profit in the books of the subsidiary is attributable to both parent and minorities. So, long story short, whether it is upstream or it is downstream, you will have to eliminate the unrealized profit in full, not just your share. You will have to eliminate unrealized profit in full. What happens is, someone might say, okay, unrealized profit was 20, out of which your share is 20 into 90%, so we will pass adjusting entry only for 18. That is wrong. You will have to eliminate the unrealized profit in full, because inventory is recorded in the consolidated balance sheet in full, that is at 120 rupees, and hence the entire 20 has to be removed, and the second effect will be adjusted. If it is downstream, then entirely against the parent's profits, because 20 is in the parent's profits. If it is upstream, it will be adjusted against the subsidiary's profits, because the subsidiary's profits are attributable to parent and minorities both, it will be adjusted accordingly. Typically, whether you adjust from pre or post depends on the date when the sale happens. However, if the date of sale is not specifically given, we will assume that the sale happens in the post acquisition period in line with the institute's solutions. Now, similar additional adjustments or complexities over here can also arise for, let us say, items like complexities might arise, let us say, for items like PP. So, if there is an upstream or a downstream sale of property, plant and equipment, then how will you do the working? Well, if there's an upstream or a downstream sale of property, plant and equipment, again you will have to eliminate the unrealized profit. However, inventory subsequently does not get depreciated, but PP can get depreciated, so it might happen that parent sells goods to the subsidiary. Subsidiary is unable to sell it to outsiders, so you eliminate 20 rupees of profit and that's it. However, if parent is selling PP to subsidiary, then parent has recorded a 20 rupee profit. Subsidiary has recorded a PP at 120, but that PP of 120 will be depreciated. That is, for example, 120 will be depreciated 12 rupees each year, and as a result, ideally, the depreciation for the group as a whole should be 100 divided by 10, because the cost of the asset for the group as a whole is 100. But the subsidiary is recorded at 120, so 120 divided by 10, and hence it has taken 2 rupees additional depreciation, which will also have to be reversed. It's a rare adjustment, but just in case it comes. And remember, the same treatment what you have done for unrealized profits also applies to unrealized losses. It is possible that because it is a subsidiary, I might sell goods worth 100 rupees at 1 rupee only, and hence there might be 99 rupee loss, because we would say theek yaar apna subsidiary hai. However, that 99 rupees loss is appearing in the parent's books. That's not really a loss, because the inventory is truly worth 100. The NRV is probably more than 100. It is just that because it is a subsidiary, we sold it at 1 rupee, and hence the unrealized loss of 99 will also be eliminated or reversed in the same way that the unrealized profit was reversed. Are we clear with this? Everyone? Any problems? Okay, so unrealized profits on intercompany transactions. This is important. Unrealized profit should be eliminated in full, not just to the extent of your share, eliminated in full from the books of the company which made the sale. This elimination is to be done till the time the goods remain unsold and are lying with either of the group companies. That is, till the time they are not ultimately sold to an outsider. Now, there are two possible adjustments for inventory. There is downstream, where parent is selling to the subsidiary, or upstream, where subsidiary sells to the parent. The profit in a downstream transaction is sitting in P's books, so profit will be debited, which is in working note 1, whereas profit over here is in S books, which is in working note 4. To inventory, which is in the balance sheet. As unrealized profit is in the books of the parent, there is no need to bifurcate between pre and post. But in upstream, as the unrealized profits are in the books of the subsidiary, we need to allocate between pre and post based on the date of the sale. If the date is not given, we will assume that the sale happens in the post acquisition period, which is in line with an ICAI assumption. Treatments for unrealized losses. The accounting for unrealized losses would be the same as unrealized gains. That is, the unrealized losses need to be eliminated unless we are specifically given that NRV is lower than the cost. And in upstream or downstream PP adjustments, the adjustments in case of intercompany PP sales would remain the same. So, you will eliminate the unrealized profits or loss as the case may be, except that instead of adjusting the inventory, we adjust the PP. Further, there would be an additional entry to reverse the additional depreciation that would be recorded in the books of the standalone buyer. So, you will reverse the upstream or downstream profit on sale, but at the same time, you should also consider the additional adjustment for depreciation that the buyer would have recorded. Just a second, let me see if there is any small question that we have included. No, I think it is a part of the bigger questions only. So, we'll probably discuss a slightly simple adjustment. I know it's getting a little heavy for you. I'm pretty sure it would be heavy for you, but I hope you are following it. Dividend adjustment, we'll keep it for tomorrow. It's slightly more complex. We'll discuss about these two items quickly. Uniform accounting policies. Is it possible that parent and subsidiary might have different accounting policies? Is it possible? What do you guys think? Well, yes. Like, these are two separate legal entities. It might be possible that parent is measuring its inventory at FIFO, whereas subsidiary is measuring its inventory at weighted average, which is fine in its individual accounts, but when you prepare consolidated balance sheet, we need to follow uniform accounting policies. So if the parents is following a particular method and subsidiary is following a different policy, for like to like transactions, for similar transactions, same accounting policies need to be followed. So let us say there is Reliance Industries parent, which is into petroleum products. There is a subsidiary called as Reliance Petroleum, which is also into petroleum products. Now Reliance Industries, for some reason in its individual accounts, prepares its inventories using FIFO, whereas the subsidiary uses weighted average method. Now, can you continue to prepare consolidation with a mixed bag? Can you show certain inventories at FIFO and certain inventories at weighted average? Is that possible? No. You will have to do consolidation using similar policies, and that means you will have to restate the subsidiary's balance sheet to bring it in line with the parent's financial statements. On an Excel sheet, you will sit, or from your exams, you will sit and convert the subsidiary's balance sheet as per the parent's financial statement. So you will change the inventory. So if you change it from FIFO to weighted average or weighted average to FIFO, as the case may be, your inventory balance will change. Accordingly, your COGS will also change, and hence your profits or retained earnings will also change. You will restate the subsidiary's inventories to bring it in line with the parent's policies. Remember, this restatement is compulsory for different accounting policies, but it is optional in case there are different accounting estimates. You can always have different accounting estimates, like there can be different estimates of useful life of PPE. However, for accounting policies like FIFO and weighted average, for similar transactions, you need to have similar policies. But if the transactions are different, like there is parent which is Reliance Industries, which is into petroleum, and subsidiary is Reliance Retail, which is into consumer products, it is possible that the parent is following a method of weighted average for petroleum because it is an appropriate method for a liquid based inventory. It is very difficult to find FIFO, whereas in a consumer business, you prefer to sell whatever has been purchased first. FIFO is very normal for consumer products. So Reliance Retail shows its inventory at FIFO, consumer products like refrigerators, TVs, etc., whereas Reliance Industries shows its petroleum inventory at weighted average. Now, do I need to restate the subsidiaries inventories to bring it in line with the parent's policies? What do you guys think? Do you need to restate it? In this case, the nature of inventory is different. Remember, uniform accounting policies are required for similar transactions accounted using different policies. If the transactions themselves are different, obviously the accounting policy can also be different. Are we clear with this? Yes? Okay. So, while preparing consolidated financial statements, uniform policies need to be followed for like-to-like transactions in similar circumstances. In case the subsidiaries policies are different from the parent, then we need to first restate the subsidiaries balance sheet in line with the accounting policies of the parent and then do the consolidation based on the restated balance sheet. So we have given the same example. And then there are different reporting dates, like parent may be an Indian company which has a 31st March year ending, but a subsidiary may be a US company which might have a 31st December year ending. Now consolidation has to be happening at similar dates. It can't be that you are taking the parent's balance sheet on 31st March and subsidiary's balance sheet on 31st December. So what will you have to do? You will have to restate the subsidiary's balance sheet to bring it in line with the parent's reporting date. Now in this case, finalization, remember, as a student you may not be able to visualize this, but in practice finalization takes a lot of time. So if I have to prepare the subsidiary's balance sheet all over again just after 3 months, it will be a very time consuming process, and hence the standard gives you a leeway. It says that you can make adjustments only for material items. You don't have to record each and every item, like you don't have to record every sales during the 3 months. You don't have to record every purchase, every salary, every rent. However, if a major item has happened, like a major asset has been purchased, or a major acquisition has done, or a major buyback has happened, if a major item has happened, you can give effect only to those material items and find a restated balance sheet on 31st March 2022 for the purpose of consolidation. This is just like in accounts, there is a trade-off between accuracy and timeliness. If you want the most accurate data, over here it will take a lot of time and it will result in an undue burden, and hence the standard allows you, say 31st December is fairly close by. In fact, the standard says if the gap is up to 6 months, it is fairly recent, then you can just make adjustments for material items. These are not important adjustments honestly, but you can just make adjustments for material items. Who will decide what is material? The question will decide. It will give you in the question that the management has identified the following items as material, and you will just give effect for those items only, nothing beyond that. You will then find a restated balance sheet, and that restated balance sheet will be used for the purpose of consolidation. So the financial statements used in consolidation should be drawn up to the same reporting date. If it is not practical to draw up the financial statements of one or more subsidiaries to such a date, accordingly those financials are drawn up to different reporting dates. Adjustment should be done for the effects of significant transactions or other events that occur between those dates and the date of the parent's financial statements. So if there's a gap of 3 months, during those 3 months, whatever material transactions have happened, you will prepare the restated balance sheet after giving effect to those material items. Like you will record the major asset purchases or major asset disposals, etc. In case there is a difference between the reporting dates, should not be more than 6 months. If it is more than 6 months, then you will have to prepare the complete balance sheet only, because they believe that it is very old information. Just making material adjustments will not do. Okay? So I think it should be enough for today. I hope this session has been helpful, and I'll see you tomorrow with more such adjustments in the next class. Okay, so welcome back, and we will continue with our journey of consolidation. So in yesterday's class, we discussed about the process of consolidation, and we discussed about the steps that you should follow for consolidated financial statements. A few important adjustments like the fair value adjustment, and then the upstream or downstream inventory adjustment. A few other not so important adjustments as well, like the negative minority interest or uniform accounting policies, or the adjustment involving different reporting dates. Now, one more adjustment which is fairly important is the dividend paid by the subsidiary. Now, typically when the dividend is paid by the subsidiary, in its individual accounts, will you record it against the parent company? So the subsidiary might give some dividend. Will you record that dividend in the parent company's books? And if you will record, how will you record the dividend in the books of the parent company? So over here, the dividend will be recorded. So let us say if there is a company S which has earned, let's say there is equity share capital of 100, profit and loss on the date of acquisition you have 200, and another 100 is earned, so you have 300 rupees. Let us say this 300, this 100 rupees is distributed out. So is it necessary that the entire dividend is distributed? No. However, you can also distribute a part of the amount in the form of dividend. Over here, let us say, just a second. Over here, let us say you are distributing around 80% out as dividend. In which case, let us say the dividend paid by the subsidiary is, let us say, 100 into 80%, or let us say the dividend paid by the subsidiaries, for example, 80 rupees. Now let us say the parent owns a 70% stake in the subsidiary, in which case in the parent's books the parent would receive bank account debit. Let us say out of 80 rupees of total dividend paid, 70% is attributable to the parent, so 80 into 70%, I guess this is 56. What will you credit? Can you guys help me with this? If the parent is recording this in its individual books as per accounting standard 13, AS 13, investments, what are you going to credit? Can you guys help me with that? Well, we will credit the dividend income, and this dividend income will go to the profit and loss account. So this 56 will be dividend income and it will be recorded in the profit and loss account. However, this is because you have acquired, let us say this is on 31st March 2022. Let us say P acquired 70% in S on 1st April 21. So this is a dividend which is paid out of post acquisition profits. Post acquisition profits are profits after the date of acquisition. However, what do you do with those post acquisition dividend? You take the post acquisition dividend into the profit and loss account. However, is it possible that dividend is also given out of pre acquisition profits? Like you acquired the company, but now you are paying dividend out of the pre acquisition profits. Like out of this 200 rupees, let us say 150 rupees is given out as dividend. In which case, in the books of P, you would receive bank account debit. So total 150 is given out of the pre acquisition profits as dividend. 150 into 70%, the stake that we have is 70%, so that is 105, which will be received by the parent. You guys tell me, as per AS 13, accounting standard 13, where will you credit the 105? This is a dividend which is paid out of pre-acquisition profits, so this is paid out of the profits which are earned prior to the date of acquisition. Excellent. This will be credited to investment. And if it is credited to investment, there is no problem. Your workings would remain correct. There will be no problem, no error in your working. Everything will fall in place because it should have been reduced from from investment. It is reduced from investment. But more often than not, what will happen is the question will tell you that let us say that S pays 150 out of pre-acquisition profits as dividend and P credits the amount received, credits the amount received to the P&L. Is that the right treatment done by P or is it the wrong treatment? This is clearly given that this is 150 out of pre-acquisition profits, and we have taken this into the profit and loss account. Do you think this is the right treatment or wrong? Well, this is the wrong treatment because ideally this should have been reduced from the investment. It should not have gone into the profit and loss account. In fact, it should have been reduced from the investment. However, it has gone to the profit and loss account. So what should you do? Ideally, you should pass a rectification entry. And for rectification, we would say, well, the P&L of the parent will have to be debited. Remember, the P&L of the parent goes in working note number 1 when we are calculating consolidated reserves. In return, what will be credited? Well, investment will be credited. So you will credit the investment as a consequence, and investment is going in working note number 2. Now, what might happen is sometimes you must have posted the dividend, posted the investment already for the purpose of calculation of goodwill. So over here, let us say P had paid, let us say 700 rupees in order to acquire a 70% stake in S. Now, after this, certain dividend is recovered. This dividend should have been reduced from the cost. You did not reduce it from the cost. However, what you did is in your working note, you took the entire 700 as investment. However, out of this 700, ideally 105 should be reduced from the investment, but that has not been done by the company. In which case, what will you do? While you are preparing the goodwill working, you will reduce 105 from the investment in order to calculate the goodwill appropriately, considering the investment correctly. Are we clear with this? So in case the correct accounting treatment is passed, there is no problem. So what are the possibilities over here? Well, it is possible that when S pays dividend, so over here, when S pays dividend, this dividend can be out of, if S is paying dividend, this dividend can be out of pre-acquisition profits, or this dividend can be out of post-acquisition profits. Now, if this dividend in fact is out of pre-acquisition profits, the parent should reduce it from the cost of investment. So over here, P should reduce. P reduces investment. Is that treatment correct? Please answer. Is the treatment correct? Well, yes, the treatment is correct, and as a result it is out of pre-acquisition profits and we have reduced the investment, and hence there will be no further adjustment. However, it might happen that dividend is paid out of pre-acquisition profits, but P credits the profit and loss account. Is that the correct treatment? No. And as a result, a rectification entry would be passed where you debit the P&L of the parent, which has gone in working note number 1, and you will credit the investment, which is in working note number 2, in order to give the effects for this adjustment correctly. Now, this is what I've written in blue is the most popular adjustment in dividend, which the institute typically prefers asking. Alternatively, the dividend can also come out of post-acquisition profits, and if the dividend is coming out of post-acquisition profits, it is possible that what should be done? Well, if dividend is out of post-acquisition profits, you will credit the profit and loss account. However, over here, let us say instead of crediting the profit and loss account, P reduces the dividend received from the investment. Is this treatment correct? Dividend is paid out of post-acquisition profits and P reduces it from the value of investment. Is this treatment correct? No. This is also incorrect, and as a result we need to pass a rectification entry whereby we will say that the investment has wrongly been reduced, so you will debit the investment to find the correct value, and ideally it should be going to the profit and loss account, and hence you will credit the P&L of the parent, which is in working note number 1. Both of these will be passed to the extent of the P's share in dividend. Okay. If P has credited the dividend received in the profit and loss account, this is the correct treatment. If it is the correct treatment, there will be no other accounting effects. Since there are no other accounting effects, we will not have any further adjustment. Are we clear with this? Just a second. I think the screen is not properly appearing. Just a second. Let me just check this. I think it should be clear now. Okay, so when we are looking at the dividend, this is when S has paid the dividend, S has recorded it and P has recorded it, maybe wrongly, maybe correctly. In certain cases, S has not recorded dividend at all. In certain cases, P has not recorded dividend as all. We need to remember these principles and solve accordingly. So if S has not recorded the dividend, one of the possible treatments could be you will record the dividend, in which case the profit of S will fall and you will create a payable. In a similar way, if P has not recorded the dividend, then you will record it correctly depending on whether it is out of pre-acquisition profits or it is out of post-acquisition profits. Okay, so keeping that into consideration, we will go to the theory for this. So this is the question bank, just a second. So if we go to the theory on page 7, dividends received are usually credited to the profit and loss account. However, in case the dividends are out of pre-acquisition profits, they should be reduced from the cost of investment as per accounting standard 13. When the holding company receives dividend from a subsidiary, it must distinguish between the part received out of pre-acquisition profits and post-acquisition profits. Dividend out of pre-acquisition profit should ideally be credited to the investment, and dividend out of post-acquisition profit should ideally be credited to the profit and loss. If the controlling interest was acquired during the course of the year, profit for that year must be apportioned into pre-acquisition and post-acquisition portions on the basis of time taken. So for example, if your date of acquisition is somewhere in the middle of the year, let's say 1st October 21, and the profits earned during the entire year were 120 and those 120 have been distributed. So out of the 120 profits, the first 6 months of profits are pre-acquisition, the last 6 months of profits are post-acquisition. And hence we will consider both of them and accordingly determine the amount of pre-acquisition and post-acquisition dividend. Any other assumption can also be taken. The treatment in case of post-acquisition dividend, well, if it is accounted for by the subsidiary, then no further adjustment needed. If it is not accounted by the subsidiary, then adjusted. You will pass the entry in the books of the subsidiary, P&L account debit to dividend payable. in the books of the holding company, post-acquisition dividend should be credited to the profit and loss account. If it is pre-acquisition dividend, which is accounted by the holding company, where is it accounted? It is correctly accounted by reducing the cost of investment, no further adjustment. However, this is the most important part. If it is wrongly accounted by crediting the P&L, then you reverse the entry pass. That is, over here you will credit the P&L. Sorry, the P&L has been credited, so you debit the P&L and credit the investment. So your adjusting entry over here will be P&L account debit to investment. If it is not accounted for by the holding company, then you will account for it, adjust at the time of consolidation. If it is pre-acquisition dividend, you will reduce it from the cost of investment. And if it is not accounted for by the subsidiary, then you adjust it at the time of consolidation. Okay, so this is about dividend. There are a couple of other adjustments like preference share capital. You guys tell me, preference share capital resembles a debenture in its features or it resembles an equity share? In its core features, it resembles a debenture. That is right. It more closely resembles a debenture because it has a fixed return on principal. It has almost a fixed rate of preference dividend, like they have interest, and hence the accounting for this would be similar to that of a debenture. So if it is preference share capital, while preparing consolidated financial statements, the cumulative preference shares issued by a subsidiary are considered in the same manner as any other liability. Like any other liability, you consider them like debentures. So like you calculate the profit after deducting debenture interest. Here the profit available that you split between the parent and the minorities will be calculated after deducting the preference dividend. So let us say your income is 100 and preference dividend is 10, then 100 minus 10, that is 90, will be attributable between the parent and the minority interest. Acha. Then there is bonus. Bonus adjustment, to be honest, is not very important, but you have to be careful in case there is a bonus in the question to calculate the stake correctly. So for example, you might have acquired, P might have acquired 800 shares in S when S had 1000 shares, which means there's an 80% stake. Now let us say S distributes a dividend, distributes a bonus on a 1:1 basis, which means there will be 1000 bonus shares and the number of shares after bonus will be 2000. The question might sometimes not tell you that P receives how many bonus shares, but you need to figure out that if S has distributed bonus and P was a shareholder then P will also receive those bonus shares, and hence in order to correctly calculate the stake, you should not compare 800 with 2000. You can either compare the pre-bonus number of shares with the pre-bonus total shares, so this is 800 with 1000, or you convert this into post-bonus, so 1600, which is the post-bonus number of shares, with 2000, which is also the post-bonus total shares. And hence this is the first thing here that you have to remember. While calculating the stake, you need to be slightly careful to ensure that in the numerator and denominator both you take the pre-bonus number of shares, and in the denominator also pre-bonus shares, or in the numerator post-bonus shares, in the denominator also post-bonus shares. Secondly, bonus is also like an appropriation. Like dividend is an appropriation, we have to figure out dividend is paid out of pre-profits or post-profits. Dividend, we typically assume the dividend of a particular year is paid out of the profits of that year. However, bonus, we don't know whether that is paid out of pre-profits or post-profits. Typically, we assume that the oldest profits are capitalized first, and unless given otherwise, we assume that the bonus is paid out of pre-acquisition profits unless otherwise given. So bonus is basically capitalization of reserves. We will assume that the oldest profits are capitalized first, and hence pre-profits will be utilized unless otherwise given. Further, bonus is a book entry and hence no further adjustment is required. Well, due to bonus, what happens is your equity share capital increases, but at the same time your pre-profit and loss reduces. So over here, let us say the shares have a face value of 1 rupee, in which case your equity share capital, which was earlier 1000, will now become 1 plus 1, that is 2000. So your equity share capital will increase by 1000 and your pre-profits will reduce by 1000. Now at the end of the day, equity share capital goes in the goodwill calculation. Pre-reserves also go in the goodwill calculation. Now ideally in the goodwill calculation you would have taken equity share capital of 1000 only. Now instead you will take equity share capital of 2000. On the other hand, let us say the pre-profits were actually 5000. you would have taken 5,000. Instead of that, you will now take 1,000. So the effects kind of cancel each other, and hence there will be no other adjustments required. If the dividend is or if the bonus is paid out of post-acquisition profits, as a safe measure, what you can do is you can say that bonus is like a book entry only, and you can reverse the effect of bonus and do the working to ensure that your goodwill is correctly calculated. Again, not a very important adjustment on bonus. There's an alternative method to calculate goodwill or capital reserve. This is based on the net assets. So you can compare the investment, that is purchase consideration, directly with the net assets. In the questions or concepts that we have discussed till now, we have focused on looking at the equity share capital and the pre-acquisition profit and loss account in order to determine the net worth. However, net worth is similar to net assets. In certain questions, you might not be given the share capital and reserves, but you might be given the assets and liabilities. You will take over the fair value of assets and liabilities. However, your consideration, let us say, is paid for 80%. You will take over 100% of the assets and liabilities. In order to calculate goodwill, you will compare what you have paid, that is 80% in the form of investment, with 80% of the fair value of the assets in order to truly and accurately calculate goodwill. After this, we will do a few problems, and hopefully that should give you more perspective on each of these items that we have discussed. Usually, we prepare cost of control account in order to calculate the goodwill or capital reserve. For preparing the cost of control, we need investment amount, which is in the form of PC, and share capital and reserves, which is in the form of net assets or net worth of the subsidiary. So we compare the investment with our share in the net worth. However, net assets or net worth can either be calculated as share capital plus reserves, or it can be calculated as assets minus liabilities. In case share capital and reserves are not available, then goodwill or capital reserve can be calculated by comparing purchase consideration, that is investment. And again, while calculating investment, if there is dividend, you have to see that is it pre or post. If it is pre-acquisition dividend, it should be reduced from the cost of investment. If not, you have to subtract it separately, with the fair value of the net assets to be taken over on the date of acquisition. While doing so, the following points need to be remembered. First, in amalgamation question, we acquire the entire company, and hence purchase consideration is directly compared with net assets. So students think that okay, in amalgamation also we calculate goodwill by comparing purchase consideration with net assets. Here also we can calculate goodwill by comparing purchase consideration with net assets. However, in amalgamation we acquire 100% of the company. In consolidation, we might acquire 80% of the company, and hence the purchase consideration is only for 80% stake. You need to compare it with the net assets, also to the extent of 80%. However, in consolidation cases, we may acquire only 70% in the subsidiary, and hence the purchase consideration is attributable only to the 70% stake. In order to calculate goodwill or capital reserve correctly, we need to compare the purchase consideration with the percentage of net assets attributable to the parent. The pre-acquisition dividend, if any, should be reduced from the investment amount. Okay, so there is a lot of theory that we have discussed. We would want to apply this in the form of questions. Let us go to your question bank. Let us go to question number 2, please. Illustration number 2. It is also similar to a study material illustration. Just a second, please. Okay, so let us read this. EXE Limited acquires 70% of the equity shares of Z Limited on 31st March 17 at a cost of rupees 70 lakhs. So this seems to be the investment amount, or PC, that is purchase consideration. The following information is available from the balance sheet of Z Limited. As on 31st March 17, you have fixed assets, investments, current assets, loans, debentures and current liabilities. The following revaluations have been agreed upon and not included in the above figures. Fixed assets are going up by 20%, investments are going down by 10%. So when you look at fixed assets, they're going up by 20%. So I think this is 120, I think 240, 120, 44, I guess. Yes, this is 144. Investments are going down by 10%. So this is probably 49.5. Yes, so this is 49.5. For other items like current assets, etc., nothing has been given. Z Limited declared and paid dividend at the rate of 20% on its equity shares as on 31st March 17. EXE Limited purchased the shares of Z at the rate rupees 20 per share. Calculate the amount of goodwill or capital reserve on the acquisition of shares of Z. So when is the dividend paid? The dividend is paid on 31st March 17 and EXE has acquired the shares in Z also on 31st March 17. So according to you, the dividend would be paid out of the pre-acquisition profits or out of post-acquisition profits? Please answer. The dividend over here will be paid out of the pre-acquisition profits or the post-acquisition profits? Well, dividend is paid on 31st March 17 itself, and hence it must be paid out of the profits which are earned prior to 31st March 17. Your date of acquisition over here is 31st March 17 only, and hence dividend is paid out of pre-acquisition profits. So over here, if you want to calculate goodwill, we typically calculate goodwill by comparing the purchase consideration, which in this case is the investment. This investment, remember, is for a 70% stake. How much have you paid? Well, we have paid 70 lakh rupees for this investment for acquiring a 70% stake. So let us say you have two columns, rupees and rupees. Let us say this is in lakhs. So this is 70 lakhs. Typically, you compare this with your share in net worth, and net worth is calculated. So this is paid on 31st March 17. Net worth is calculated as share capital plus reserves. We don't have the reserves over here, and hence we can look at net assets. Again, what is your share? Your share is 70% of the net assets on 31st March 17. You guys tell me, will we take the fair value of net assets taken over, or will we take the book value of net assets taken over? Well, we will take the fair value of the net assets taken over, which is over here 144, then 49.5 on your calculators, 144, 49.5. I'll just do it directly. Then 70 being current assets, 15 being loans and advances. Debentures you will have to subtract, so minus debentures minus current liabilities minus 90 minus 50, 273.5. Please verify and tell me if that is correct. This is net assets. Total net assets will be 273.5. How do we calculate this? Well, 144 plus 49.5 plus 70 plus 15 minus 90 minus 50. तो कोई और नंबर आ रहा है, just a second. 144 plus 49.5 plus 70 plus 15 minus 90 minus 50. So this is 138.5, I guess. So this is 138.5, and we are getting a 70% stake. Of net assets worth 138.5, we are getting a 70% stake. So this is, I think, 96.95. So something which is worth 96.95, you have paid 70 rupees. So over here, have you paid more or have you paid less? Well, you seem to have paid less, and hence the natural thought over here would be you would directly try and say that the difference is capital reserve, which is okay. However, there is one more adjustment over here. The question says Z declared and paid a dividend of 20% on its equity shares on 31st March 17. EXE purchased the shares of Z at 20 rupees per share. So how many shares? So the number of shares held by EXE will be, you will have rupees 70 lakhs, and on this rupees 70 lakhs you divide this by rupees 20. So that gives you 70 divided by 20 comes to around 3.5 lakh shares, and the dividend is 20%. So over here we have been given let us say the face value of these shares are assumed to be rupees 10. It is not specifically given. You can also have another assumption, which means the dividend received by EXC would be 3.5 lakh shares into rupees 10. Dividend is a percentage of face value into 20%. So over here this is 3.5 into 10 into 20%. This is dividend of rupees 7. You guys tell me, where should this dividend of 7 go? Where should this dividend of 7 go? Should it go to the profit and loss account, or should it be reduced from the value of investment? Well, it should be reduced from the value of investment, and as a result you would say less pre-acquisition dividend. The pre-acquisition dividend over here is 7. This will reduce the cost of the investment, and hence you will get 63. This 63 can be compared with your share in the net assets, which is, let us say, 96.5, and as a result the difference between these two will be capital reserve. So this is one alternative method to calculate goodwill or capital reserve, where we are comparing the investment with the net assets, your share in the net assets. In other sums you will typically take net worth. Here you are comparing it with your share in the net assets, and hence 63 minus 96.95, and we get 33.95 on a simplistic basis as a capital reserve. So this will be the capital reserve that you will show in your balance sheet. Are we clear with this? Any problems here? Okay, so next we go to now question 3 is consolidated P&L. We'll do that right at the end. Question 4 involves changes in accounting policies. Again, it's not as important. We'll do it at the end. Go to question number 5 now. Question number 5. Let us read this. A Limited acquired 1600 ordinary shares of rupees 100 each in B Limited on 1st of July 2016. This is your date of acquisition. On 31st December 2016, this is DOC, date of consolidation. The summarized balance sheets of the two companies were given below. So you have land and building, plant and machinery, investments in B at cost 3,40,000, inventory, trade receivables and cash, capital reserves, profit and loss, bank overdraft, trade payables. The profit and loss of B showed a credit balance of 30,000 on 1st January 16. This is not the date of acquisition. This is the start of the year. Out of which dividend of 10% was paid on 1st August 16. You guys tell me. Dividend seems to be paid out of pre-acquisition profits or post-acquisition profits. The question says the profit and loss showed a credit balance of 30 on 1st January, out of which dividend of 10% was paid on 1st August 16. You have to identify whether it is a dividend paid out of pre-acquisition profits or post-acquisition profits. A credited the dividend received to its profit and loss account. Acha. So whether A has done the correct treatment or not depends on whether you identify this dividend to be pre-acquisition or post-acquisition. So this is the first adjustment in this question, the dividend adjustment. Second, the plant and machinery stood at rupees 1,50,000 on 1st January 16 was considered worth 1,80,000 on 1st July 16. This figure is to be considered while consolidating the balance sheets. The rate of depreciation on the plant and machinery is 10%, computed on the basis of useful lives. This is the second adjustment. Prepare consolidated balance sheet on 31st December 16. So this is a very typical exam type of a question, and we'll do it, not in absolute fair terms, but at least to the best extent that we can for a clear understanding. Let us say in question number 5, you will first identify what the date of acquisition is. Well, the date of acquisition is 1st of July 2016. The date of consolidation, which is 31st December 16, and the stake that A holds. So A's stake in B is owning 1600 shares. There is no bonus over here. These are 1600 shares out of 2 lakh divided by 100, that is 2000 shares that are in B, and hence A owns an 80% stake in B, which means the remaining is attributable to minorities, that is 100% minus 80% equals 20% is attributable to minority interest holders. Once you have identified these basic facts, you will go to preparing the Schedule 3 balance sheet, which is A Limited and its subsidiaries. Whenever you prepare consolidated balance sheet, you will prepare it not just for A, but A Limited and its subsidiaries. You will write the words consolidated as well. So this is consolidated. Let us say balance sheet. I'm just writing all of this in short. You will have to write the full forms as at, let us say 31st December 2016. You will prepare this in the Schedule 3 format. I'll probably skip this for the time being, but just to discuss, you will first start with, over here, let us say you have rupees in, that's it, rupees, there's no lakhs or something. So rupees, particulars, notes, you will start with equity and liabilities. I'm writing all of this in short, within which you will have shareholders funds, within which you will have share capital, within which you will have reserves and surplus. Within the liabilities section, if you go to see, there is bank overdraft and trade payables, both of which are current liabilities. So there is short-term borrowings, which is in the form of bank OD. You can write that in the brackets as well. And I'm writing this in short, trade payables. So all of this will give you the Schedule 3 format. It's a bit of a mess over here, but I hope you understand. In the interest of time, we are not going into too much of working. So let us say beyond this, just a second, chalo, theek hai. You will look at assets. Within assets, you will have non-current assets. Within non-current assets, you will have property, plant and equipment. Within that, there will be a tangible item and there would be intangible items which can potentially be in the form of goodwill. Apart from that, investments are there, but that will get eliminated. There is inventories, trade receivables and cash, which are all a part of current assets. So this is, let us say, inventories or stock, trade receivables and cash equivalent. So this is your step 1 where you prepare the Schedule 3 format. Once you prepare the Schedule 3 format, you will prepare notes. Preferably the institute prepares notes one by one. So let us say, for example, they start with share capital or they start with property, plant and equipment, where they will write, let us say, your land and building, plant and machinery, then inventories. Within inventories, A Limited, B Limited. Within trade receivables, A Limited, B Limited. Within cash, A Limited, B Limited. For simplicity over here, I'm just doing this directly so that you get a perspective. So there is A, there is B. You typically prepare this in the vertical format, not in this horizontal format. Adjustments and total. So over here we will start, let us say, with you can go in any order. Let us say I start with land and building. So let us say you will have a note 1 where you have land and building, in short, plant and machinery, and that will be the total of property, plant and equipment tangible, which will appear in your balance sheet. So you will have 1,50,000, 1,80,000, 2,40,000, 1,35,000. So 1,50,000, 1,80,000, 2,40,000, 1,35,000. Similarly, investments, we will not take that. Second, we will take inventory. Ideally, we will do this in the vertical format where you will say inventory, then for A, then for B, which is 1,20,000, 36,400. I think there is one more zero wrongly printed over here. So this is 1,20,000 and 36,400. You are basically consolidating every line item. 0.3 trade receivables, 0.4 cash and cash equivalents. So this is 59,800, 40,000. 59,800, 40,000, cash and cash equivalents being 14,500 and 8,000. So this is a slightly tedious process, but a process which nevertheless needs to be done. Then there is bank overdraft and then there is trade payables. So we will jot down 80,000 and then 40,000, 40,000, 47,100, 17,400, 47,100, 17,400. So with that you have taken all assets and all liabilities except for share capital and reserves. For share capital as well, you can put a separate note, which is, let's say, equity share capital. We will consider only the share capital of the parent, which is 5,000 equity shares of rupees 10 each, let us say fully paid, of rupees 100 each, let us say fully paid, in which case you have considered this 5 lakhs as well. You can have a separate note on reserves, and then comes the most important part of this question, for which you will be typically given credit, that is preparing the 3 working notes. Your working note number 1 will be consolidated reserves. Now there is just a single reserve, which is profit and loss, and hence you will take that only. You will start with standalone parent, which is 57. There are 2 reserves, so this reserves and profit and loss. So we will say consolidated reserves and surplus, which is made up of 2 items. There is reserves and then there is profit and loss. You will start with standalone parent. So this is standalone A. You will show 2,40,000 and then 57,200. So with that you have shown both of these items. So everything on the liability side of A is taken care of. You can leave typically around 8 to 10 lines over here and then go to working note number 2, which can be the goodwill statement if you want to prepare, or it can also be the cost of control, whatever you are comfortable. You can prepare this in the ledger form, you can prepare this in the statement form, it does not really matter. The stake that you have is 80%. So let us say if I were to prepare this in a statement form, I will start with the amount of investment. I will start with the amount of investment, leave a couple of lines and then share in net worth. We don't have the net assets on 1st July 16, which is the date of acquisition, but we can try to find our share in the net worth. Similarly, around 8 to 10 lines you can leave, and we have the last of the working notes, which is, let's say, minorities interest. Now what do we need to do? We need to get the investment out of the way. So your investment is 3,40,000. So let us say in the inner column investment is 3,40,000, unless there is any other adjustment that will be taken. And so investment is taken over here. If your cost of control account is prepared, then in the cost of control you will debit. On the debit side you will say to investment 3,40,000. Now equity share capital is attributable, 2 lakhs is attributable 80% to the parent, 20% to the minorities. So this is equity share capital, 80% attributable to the parent, 80% of 2 lakhs, which will come to, I guess, 1,60,000, and 20% of this is attributable to the minorities, which is, I think, 40,000. Now in my opinion, this is the stage where you should typically reach in an exam in around 10 to 12 minutes, where you have read the question, you have prepared, taken the given data, prepared the schedule 3 format, written the notes on assets and liabilities, prepared the working notes, and at the end, at this point, this is the mechanical process. At this point, only these 2 numbers that you can see over here, which is the reserves of the subsidiary, should be pending, and whatever adjustments are given in the question, that should be pending. So your working note number 4 will focus on those adjustments, and if you take those adjustments and these balances, your answer is done. Now the question tells you that the profit and loss of B showed a credit balance of 30,000 on 1st January 16, out of which blah blah blah. Nothing is given about this 1 lakh. We don't know when this 1 lakh was earned. In such cases, ICAI assumes that this 1 lakh must be earned prior to the date of acquisition. Can it be earned after the date of acquisition as well? Very well, yes. However, if nothing is given, we will do working note number 4, which is analysis of reserves. Why analysis? Well, all assets and liabilities consolidated, investments and share capital of the subsidiary eliminated, but reserves of the subsidiary analyzed. Which means you have to allocate between pre and post, and then between parent and minority. Over here, let us say subpoint A is reserves. These reserves, unless given otherwise, are assumed to be pre. They are assumed that these reserves existed prior to the date of acquisition. So over here, if they are fully pre, I mean, we don't need to then analyze much. Out of this 1 lakh, we can say 80% of this is attributable to the parent. Parent over here is A, and the remaining 20% is attributable to minorities. So 80,000 over here and 20,000. 80,000 over here will go in working note number 2 for goodwill calculation, whereas 20,000 is attributable to minorities, goes in working note number 3. So this is pre-reserves, your share in the pre-reserves. You are trying to find your share in the net worth, for which you will need your share in the reserves as on the date of acquisition. We are assuming 1 lakh existed as on the date of acquisition. 80% of that is 80,000 over here. The minority share in the pre-acquisition reserves is, let us say, 20,000. Now comes the most important working, which is on retained earnings or the profit and loss. Now if you go to see in your profit and loss, typically we can prepare this in a chart form, or we can even prepare this in a statement form. So over here, let us say there is particulars. In your particulars, you will have total, then you will have the pre-section, and you will have the post section. Pre-section can also be called as a capital, post section can be revenue. You start with the given balance. The given balance is a balance on 1st January 2016, that is 30,000. Why should this balance increase? Well, it should increase due to the profits of the year 2016. Why should this balance reduce? Well, due to dividend that has been paid. The dividend is paid on 1st of August 2017. And what is the value of the dividend? It is 10%. 10% is generally a percentage of the share capital. So 2 lakhs into 10% will come to 20,000. So this is the dividend which is paid, 2 lakhs into 10%. This is paid on 1st August, but it is very clearly given that it is paid out of pre-acquisition profits. So over here your dividend, let us say, will be 20,000, and hence you will have the closing balance. So this is the balance, let us say, on 31st of December 2016, which is printed and given in the question as 82,000 in the profit and loss. So this is 82,000, and hence if you back calculate, we will say that the balancing figure over here seems to be 72,000. This must be the profit during the year. What is the date of acquisition? The date of acquisition in this question is 1st July 2016, which means all profits prior to 1st July is pre, all profits prior to after 1st July are post. 30,000 is the balance on 1st January. This is earned prior to the date of acquisition, and hence this is entirely pre. Whereas 72,000 is for the year 2016, which is 1st January 16 to 31st December 16, and hence 6 months of this will be pre, whereas 6 months of this will be post. And as a result, 36,000 will go in the pre section, 36,000 will go in the post section. As the question has mentioned, that this dividend is paid out of the balance on 1st January. This is out of pre-profits as given in the question. Had it not been given, you could have made some other assumption as well, but here it is very clearly given. And hence we have the balance in either cases. So this is 30 and 36 minus 20. So this is 46,000 and 36,000. So we have tried to break down 82 between pre and post. Typically we will allocate it directly to the parent and minorities. However, in this case there are some workings. So typically we leave around 8 to 10 lines again, and then prepare a working note number 5 for the adjustments. What are the adjustments over here? Subpoint A, there is a dividend adjustment. What is the dividend adjustment? Well, dividend has been given to be paid out of the pre-acquisition profits, and the parent has credited the dividend to its profit and loss account. You guys tell me, is that correct? Is that wrong? The dividend is paid out of pre-acquisition profits, and it has been told that A credited the dividend to the profit and loss account. Is that correct or is that wrong? Well, it is wrong, which means you need to pass a rectification entry. Even if you don't pass, you need to give the effects. What is a rectification entry? What are you going to debit? Well, you have wrongly credited the profit and loss of A, which is appearing as a part of working note number 1, and you should have reduced the investment, which is appearing as a part of working note number 2. To what extent? Well, the total dividend, if you go to see, is 20,000. But A does not receive 20,000, it receives 80% of 20,000, which is 16,000. And hence 16,000, which is already included in all likelihood in the P&L of A should not be included, and hence we will subtract from this pre-acquisition dividend to the tune of 16,000. The second effect of this would be against the investment. Ideal investment is appearing at 3,40,000. However, if you subtract the pre-acquisition dividend, the investment actually should appear to be slightly lower, which is 3,40,000 minus, let us say, 16,000. Now, instead of preparing a statement, you could have also had a cost of control, in which case investment would have been on the debit side, equity share capital pre-reserves and also pre-acquisition dividend would have come on the credit side. So, your rectified investment will be 340 minus 16 comes to 3,24,000. So, that takes care of the dividend adjustment. However, there is also a fair value adjustment where you have taken over assets and liabilities. One of them is plant and machinery. This plant and machinery on 1st of July 2016 has a fair value as given in the question. It has a fair value of 1,80,000. So, the question says was considered to be worth 1,80,000 on 1st July. So, this is fair value of 1,80,000. However, what is the carrying value or the WDV of this plant and machinery on 1st of July? Well, at the start of the year, it was 1,50,000. The question tells you that at the start of the year, the plant and machinery which stood at 1,50,000 on 1st January 16 was considered to be worth 1,80,000. This figure is to be considered in consolidating the balance sheet. The rate of depreciation is 10%. Do you think I can compare 1,80,000 directly with 1,50,000? Well, no, because 1,80,000 is a balance on 1st July, whereas 1,50,000 is a balance on 1st of January, and hence you will have to record the depreciation, which is 1,50,000 into 10% into 6 by 12 into 10% into, let us say, 6 by 12, which comes to 1,50,000 into 10% into 6 by 12, 7,500. 7,500 and 1,50,000 comes to 142,500. So, the plant and machinery on the date of acquisition in the books of B would be 142,500, but its fair value is 1,80,000. So, that is an upward adjustment. Therefore, upward revaluation on 1st July 16 would be 1,80,000 minus 142,500. So, this will be, let us say, 37,500. Due to this, your plant and machinery will increase. So, if on 1st July 2016, if I were to pass this entry, Institute does not pass this entry, it directly gives the effect, but plant and machinery will be debited by 37,500. What will you credit? Well, we will credit reserves because this increase in plant is attributable to the owners. However, which reserves? You guys tell me, will you credit the pre-acquisition reserves or will you credit the post-acquisition reserves? Which of the reserves should you credit? Well, we will credit the pre-acquisition reserves because this is attributable to profits which are earned prior to the date of acquisition, and hence 37,500 effect will be given against the pre-acquisition reserves. This appreciation had already happened on 1st July 16 and hence it is attributable to pre-acquisition section. So, over here you will increase your plant and machinery, let us say, by 37,500 fair value appreciation, and secondly you will also increase the pre-acquisition profit. So, this is plus initial fair value adjustment. This initial fair value adjustment on plant and machinery is worth 37,500, and this 37,500 we have analyzed and segregated to be in the pre-section. However, if the plant and machinery increases by 37,500, we cannot say that the depreciation will remain the same. So, basically the depreciation based on fair value for the period 1st of July 16 to 31st December 16 will be based on 1,80,000, based on fair value of 1,80,000 into 10% into 6 by 12. So, this is depreciation which is based on the fair value should be recorded. So, this is 18,000 divided by, so this should be 9,000. However, depreciation which must have been already recorded in your books for this same period would be, it is 1,50,000 into 10% into the last 6 months. So this must be 7,500, and hence we will have to book the additional depreciation. We will have to book the additional depreciation to the tune of 1,500. This additional depreciation to the tune of 1,500 is the depreciation for the period 1st July 2016 to 31st of December 2016, and hence this is the post-acquisition period. This additional depreciation reduces your post-acquisition profit, so this is post-P&L account debit. One effect of the depreciation goes against the P&L, the second effect goes against the plant and machinery, which is the PPE, 1,500. So this 1,500, you will again give two effects. Over here we can say less additional depreciation on the plant, which is 1,500. It is not considered by B in its standalone books, but it has to be considered in the consolidated books, because you are telling the world that the land is or property is worth 1,80,000, when in the books standalone it was worth 1,50,000 or 142,500, as the case may be. This is one adjustment. The second adjustment will be against plant and machinery, where you subtract 1,500. And with that you have considered the dividend adjustment, the fair value initial as well as the subsequent adjustment. Next, you look for intercompany items like trade receivables, trade payables intercompany, bills receivable, bills payable intercompany. If nothing of those are there, in which case you are now in a position to total up the reserves. You can say that, okay, the adjusted P&L after all the adjustments and split will be 82,000 plus 37,500 minus 1,500 comes to 1,18,000, and this 1,18,000 is 46 plus 37,500, which is 83,500 in the pre-section, and 36 minus 1,500, which is 34,500 in the post section. 34,500, 83,500, which is 1,18,000, and this will be attributable to A 80%, minorities 20%. So 83,500 into 80% is 66,800 will go in the goodwill workings, working note 2. This is your share in the pre-acquisition profits after considering the dividend, after considering the fair value adjustments, everything. And the difference 16,700 will be attributable to minorities. Minorities don't care whether it is pre or post. 34,500 into 80%, which is 27,600 coming from working note number 1. This is your share in the post acquisition profits, minus 34,500, and it comes to 6,900, which is going to working note number 3. I'm sorry if these numbers sound to be very intimidating to you, but otherwise if you sit and solve this question in the regular manner, it will take more than an hour to solve. We'll kind of cancel the entire objective of doing the revision over here. We're just here to discuss the principles and concepts, though we are trying to solve this one fully to the best extent possible. So 66,800 will be your share in the pre-profit and loss, and the remaining 66,800, and the remaining is attributable to the pre-P&L, which is for minorities, which is 16,700. So this is also taken care of. Then 27,600 is your share in the post acquisition profits, plus share in post acquisition B, which is 27,600. And to the minorities, you will get the post acquisition profit and loss, which is 6,900. With this, everything has been considered. So basically, if everything is considered, then what will be the effects? If everything is considered, then what will be the effects? Well, you will now try to total every item. So over here, let us say working note 2, 1,60,000 plus 80 plus 66,800, 3,06,800, which means for something which is worth 3,06,800, effective 324, and hence there is a 17,200 goodwill. Then comes minority interest. So this is 60 and 16,700 and 6,900. So this is 83,600. Once that is done, so this is 17,200, 83,600. We will also consolidate the reserves, which is 2,40,000 and 57,200 minus 16,000 plus 27,600 comes to 68,800. If you total both of these, it comes to 3,08,800. Where will the 3,08,800 go? It will go in the balance sheet as consolidated reserves. 17,200 will go in the balance sheet as goodwill, and 83,600 will go as minorities interest. Now we are in a position to even total up the assets and liabilities. So this is 1,50,000 and 1,80,000, 3,30,000. For plant, you will take 2,40,000 plus 135, and then you will also take the adjustments, that is plus 37,500 minus 1,500, and the plant is 4,11,000. So your total property, plant and equipment will be plus 3,30,000 will be 7,41,000, which will be taken in the final balance sheet. Inventory will be 156,400. This is 99,800, 22,500, 80,000 and 47,100. I've done this orally, most of them. Hopefully there is no calculation error. 64,500. So if we take these numbers, let us say your shareholders funds will be share capital. Just a second, there we need to make some space for minorities as well. I missed out recording the minorities. So over here there will be 0.2 minorities interest. It is always advisable that you leave a line, so eventually it is like this, you can write it down directly. So let us say share capital is directly, I think, 5 lakhs. Reserves and surplus comes from working note number 1. You have taken 3,08,800. Minorities from working note number 3, 83,600. Bank overdraft from your note number 5, 80,000. Trade payables from your note number 6 is 64,500. PPE from your note number 1 is 4,11,000 and 330, 741. Goodwill from working note number 2. Just pull this down. Goodwill from your working note number 2, I think, is 17,200. Inventories over here will be 156,400. 99,800 on trade receivables and 22,500 for cash. So this is how your entire process will flow. We have tried to solve one full problem to the best extent possible. Pray to God that your balance sheet tallies. 83,600. This is the most nervous time in your paper typically when you are trying to total up a consolidated balance sheet. I hope this does tally. 1036,900, 741, 17,200, 156,400, 99,800, 22,500, and you have 1036,900. Did we get a sense of the steps and the methods we had discussed along with the adjustments? This is typical exam grade question. Did we get a sense of how we flowed through? I mean, forget the numbers. I can understand that over here every number to comprehend is difficult, but the flow, most important thing. Are we clear with that? Great. So on similar lines, we will discuss question number 6. I'll not go into such a detailed calculation of an adjustment by adjustment. We'll probably tackle the important working notes and adjustments in that question, and hopefully that should suffice. So this is the next question on balance sheet, which is question number 6. Here there are slightly different adjustments. So in this question we had a fair value adjustment, dividend adjustment. Here probably you will have a bonus adjustment, upstream or downstream transfer adjustment, etc. So let us read. On 31st March 17, the summarized balance sheets of H Limited and its subsidiary S Limited stood as follows. So this is a balance sheet for H and S. Share capital for H and S, authorized, issued and subscribed, equity shares of rupees 10 each fully paid, general reserve, profit and loss, bills payable, trade payable, provision for taxation, dividend payable. So a lot of things. Assets comprising of land and building, plant and machinery, furniture and fittings, and then you have investments in shares in S. Stock, trade receivables, cash at bank, bills and receivables, and trade advances. So a lot of items are there. The following information is also provided to you. H purchased 180 lakh shares in S on 31st March 16. So your date of acquisition is 31st March 2016. And the balances of general reserve and the profit and loss account of S stood at 3000 lakhs and 1200 lakhs respectively. So this gives you the date of acquisition and the reserves on the date of acquisition so that you can find the net worth. On 1st April 16, S declared, so on the date of acquisition itself, S declared a dividend of 20% for the year ended 31st March 16. H credited the dividend received by it to the profit and loss account. Now looking at this, what do you guys think? Is the treatment correct or is the treatment wrong? H has credited the dividend received by it to the profit and loss account, and the dividend is paid on 1st April 16 itself. The treatment seems to be wrong. It should be credited to the investment. It has gone to the profit and loss, and hence you will have to pass a rectification effect. On 1st January 17, a good 9 months later, the new adjustment, S issued 3 fully paid bonus shares for every 5 shares held out of balances in the general reserve as on 31st March 2016. So this is balances in the general reserve on 31st March 16. So this is a bonus paid out of general reserve balance on the date of acquisition, and hence this bonus is also paid out of pre-profits. So this is a bonus adjustment. There's a dividend adjustment as well. On 31st March 17, all bills payable in S balance sheet were acceptances in favor of H. But on that date, H held only 45 lakhs of these acceptances in hand, the rest having been endorsed in favor of trade payables. Achha, if you endorse the bills, the journal entry typically is, if I have bills receivable and if I endorse the bills, my journal entry will be trade payables account debit to bills receivable. So I no longer hold the bills, I've given the bills to someone else. Okay, so this is an intercompany payable or receivable adjustment. And lastly, on 31st March 17, S's inventory included goods which it had purchased for rupees 100 lakhs from H, on which they made a profit of 25% on cost. So this is an upstream or downstream adjustment. So if I look at just these two questions, almost all the major variety gets covered. Your adjustments over here, upstream or downstream inventory adjustment is covered, dividend is covered. In the last question, you had fair value adjustment which was covered. Then you have bonus which gets covered over here, dividend. So between these two, it's very likely that if a consolidation question comes, it will be a mix and match of these adjustments. Prepare a consolidated balance sheet of H and its subsidiary S on 31st March 17. What I want you to do is to glance through this question and give me 2 important data points. First, try to calculate and tell me the stake that H has in S, and second, you calculate and tell me the dividend received by H. You calculate and tell me these 2 numbers, please. The stake and the dividend received. What is the stake that the company has, H has? So what a student typically does is they compare 180 with the number of shares. So they say, okay, that is 4,800. They compare 180 lakh shares that H has purchased with 4,800 divided by 10. So that is 480. That is wrong. Why is it wrong? Well, because over here we have acquired the stake of 180 lakhs on 1st of April 2016. Bonus was subsequently given on 1st of January 17. When I look at HK number of shares, it is 180, but when I look at total number of shares, you get the number of shares in the question as 480, but 480 is the number of shares on 31st March 2017. These are the number of shares actually after the bonus, and hence if you compare 180 and 480, it is not going to give you the correct answer. So over here, S issued 3 fully paid bonus shares for every 5 shares held out of the balances. So basically, there would be 180 into 3 by 5 additional shares. 180 into 3 divided by 5, that is coming to 108. And hence your total number of shares post the bonus will be 180 plus 108, that is 288. So you are having 288 shares out of 480, and hence that can be calculated. So your percentage stake can either be calculated as 288 upon 480. So 288 upon 480, this can come to 60%, or you can back calculate. You can say that okay, if this was pre-acquisition shares were 5, then bonus shares will be 3, and hence the total shares post bonus will be 8. Say 480 divided by 8 will come to 60 into 5, that is 300. Your total number of shares pre the bonus will be 300, and into, let us say 180. So 180 will be the bonus share. So you can either compare the percentage as 60 on a post bonus basis, or you can compare it on a pre-bonus basis, where you compare 180 divided by 300. So these two, you can either compare 180 and 300, or you can compare 288 with 480. In which case, you'll have 180 by 300, which will also give you, let us say, a 60% stake. So this is what we meant when we said in bonus, you have to be careful in the stake calculation. You cannot compare 180 with 480, they are not an apple to apple. So your working will be done based on 60% stake. If you wrongly take 180 and 480, the examiner will not even evaluate your solution further. Now the next point is how much is the dividend. So let us say this is about bonus, and if I want to pass the entry for bonus, as the question has told you, the entry is general reserve account debit, and this is general reserve arising out of the pre-acquisition section. General reserve account debit to, let us say, equity share capital. There are a total of 180 lakh in terms of bonus shares. So this is 180 lakh. So this is 300 pre-bonus shares. 300 into 3 by 5, and every share is, I think, worth rupees 10, I guess, in this question. Every share is worth rupees 10, and as a result, we will have 300 into 3 by 5, 180 into 10. So this is probably 1800. Do we have enough balance in the general reserve? Yes, 1800 will be the entry. This entry has already been passed. Secondly, we want to figure out what is the dividend. So ideally, you should prepare the Schedule 3 balance sheet, then you prepare all assets and liabilities, everything. But then what is the dividend amount? Remember, dividend is paid on which date? On 1st April 16. So what will a student typically make a mistake? He will say that dividend is declared at the rate of 20%. So he will look at 4,800, and the student would say 4,800 into 20% will give you the dividend, which is wrong. 4,800 becomes a share capital today. However, this dividend was given on 1st April 16 when the then prevailing share capital comprised of 300 shares. So the dividend was 300 shares of rupees 10 each into 20%, and as a result your dividend will be 600. This is your total dividend. Out of this 600, let us say 60% comes to the parent, the remaining 40% goes to the minorities. But your total dividend, that is right, is going to come to 600. Okay, so what are we going to do? We are not going to prepare the entire balance sheet over here, but I want to run you through the three crucial working notes. So this is working note number 1 on consolidated reserves and surplus. Then you have a working note number 2, which is on the goodwill working, and then you have working note number 3, which is on the minorities interest. So we start the working note on reserves. So there are two items, there is general reserve and then there is P&L. We do this in a columnar form. So we start at standalone parent, which is standalone H. Standalone parent balances over here is 2784, 2715. So this is 2784, 2715. In goodwill working, we start with the investment. Over here, the investment balance is just a second. I think my machine has my iPad is hanged. Just a second. So we will recognize the investment over here. Let us say the investment over here will be in the inner column 3000. Remember, your bonus shares does not result in any additional investment, so your investment will be 3000, and then you will compare that with your share, that is 60% in the net worth as on the date of acquisition, that is 1st April 2016. You will take equity share capital. Remember, equity share capital, what should you take? Well, whatever is appearing in the books has to be eliminated. In your books today, 4800 is appearing. One can always argue and say that as on the date of acquisition, we had only 3000. However, today we have 4800. You need to eliminate the entire 4800, out of which you have a 60% stake. Minorities, equity share capital, this is 4800 into another 40% stake. So this is 4800 into 60% comes to, let us say, 2880, and minorities will come to, let us say, 1920. Okay, so over here the effect of bonus has been considered in the way that the equity share capital has swelled, it has increased. Now you go to the analysis of reserves, where you go to working note 4 subpoint A, where you try to analyze the general reserve. Within the general reserve, you have the balance given on 1st of April 2016. The total balance is 3000. Why should this balance change? Well, if there are certain profits during the year or a certain increase, you can transfer money from the profit and loss to general reserve, or you can even earn money which directly goes in the general reserve, like in case of share-based payments, in case of ESOPs, if the ESOPs lapse, the balance can go to the general reserve. So there can be certain profits which are directly adjusted against the general reserve in the year 16-17, and question very categorically tells you that the bonus is out of general reserve. That too, it is out of the opening balance in the general reserve. The bonus is around 1800. It is out of pre-profits, and hence you will get the balance of the general reserve on 31st of March 2017. If you see the question, the balance in the general reserve on 31st March 17 is 1380, and as a result there is a potential increase. So ideally the balance should be 1200, but there is an increase of 180. This is happening during the year 16-17. So if I were to segregate this between pre and post, we would say this 3000 is entirely pre, 180 is entirely post, and 1800 is also out of pre-profits. Sometimes people say that this 180 is also to be treated as a transfer from the P&L to general reserve. You can even do that, or you can treat it as an earnings directly in the general reserve. Ultimately, the final effect under both will be the same. So this is 1200 out of the pre-profits and 180 out of the post-profits. Adjustments are done to the profit and loss, not separate adjustments to the general reserve. And as a result, a part of this will be attributable to H, 60%, the remaining part to minorities, 40%. So this is 1200 into 60% comes to 720, and let us say 480, 180 into 60% comes to 108, and let us say 72. We will take these in the respective places. So over here this is pre general reserve 720, minorities you will have pre general reserve 480, post general reserve, which is in the minorities, is 72, and your share in the post acquisition general reserve or profit and loss would be in the general reserve 108. Okay, then you go to the profit and loss. Again, the working remains broadly standardized. You will take the profit and loss on 1st April 16. Why should this increase? Well, due to the profits of the year 16-17. Why should it reduce? Well, due to the dividends that have been paid, and that will give you the balance on 31st March 2017. So the profits at the start of the year, if you go to see, are 1200 lakhs, and at the end of the year are, let us say, 1620 lakhs. So this is 1200, 1620, and during the year we have found that the dividend of 600 has been paid. So 1620 is the profit and loss. 1200 was there at the beginning, and during the year we have said that 20%, that is 600 rupees of dividend has been paid, which means whatever is remaining must be the profit during the year. 1200 minus 600, and if you subtract 1620, I think we get 1020. We segregate this between pre and post. Within the pre section, the entire 1200. 1020 is entirely post, like in the last question, the acquisition happened in the middle of the year. Here the acquisition happened at the start of the year. And from this you subtract 600, and as a result you get 1200 minus 600, which comes to, let us say, 600. 1020 over here. A few adjustments that you need to do, and hence we typically leave some space and then prepare, let us say, working notes. When we are preparing these working notes, we will say the adjustment is for dividend. Dividend is wrongly credited. 600 is the total dividend. Parent receives 60% of that, that is 360. This should be debited in the P&L. Debit, this is going in working note number 1, and to investment will be credited in working note number 2. So this is 600 of total dividend into 60%, and hence this comes to 360. Like in the last question, you will reduce the pre-acquisition profits less pre-acquisition dividend worth 360. Second effect against investment 360, because it had gone in the profit and loss account, so you remove it. So this is less dividend. So this is 3000 minus 360 comes to 2640. Pre-acquisition dividend is getting reduced. Now a couple of new adjustments which are there. So we have given effect to the dividend adjustment, we have given effect to the pre-profits, to the bonus adjustment. Now we want to look at the inventories. Now inventories, what is happening on 31st March 17, that is at the end of the year, SS inventory included goods which it had purchased for 100 lakhs from H, on which H made a profit of 25% in cost. So over here H sold goods to H. So H, which is a parent, sold goods to S. In the books of S, these are appearing at 100. 100 over here includes profit. Profit is 25% on cost. 25% on cost to H, that is 25% on cost is 1/4 on cost, which is 1/5 on selling price. So let us say if your cost to H was X, then the profit over here is 25% of X, and hence your selling price becomes 1.25x. Now if this 1.25x is 100, then X is how much? Most importantly, 0.25x is how much? So if you take 100 divided by 1.25 into 0.25, so this will probably come to 20 rupees. So your unrealized profit is 20, and this profit is included in the books of the parent, which is in working note number 1. It is a downstream transaction where H has sold, and hence this is in the books of parent 20, P&L account debit 20 to, let us say, inventory 20. So with that, what you will have to do is your unrealized profit in downstream transaction is 20. You will reduce it from the P&L. The second effect will go against inventory. So when you are measuring inventories, within inventories you will say minus 20. Whatever is the total inventory, minus 20 will be your inventory appearing. So that takes care of adjustment E. And within bills payable, all bills payable were acceptances in favor of H. So you have to pay to H. However, H has endorsed and only 45 lakhs of the acceptances remain. So out of your total bills receivable, H has endorsed some of them, the remaining are still there. Out of your total bills payable, some of them are there. So as a result, we will have 45, which is intercompany. The remaining have been endorsed, and hence S has to pay to a third party, no longer to H. Earlier we were saying, theek hai yaar, money has to be paid by S, received by H. However, this is to be paid by S, but not really received by H. It has to be received by a third party because endorsement has actually happened. And hence 45 will be the bills payable, corresponding adjustment in the bills receivable. And that's it. After that, you will go through the regular process of balancing, taking the working note 1 balance, then the goodwill or capital reserve, then the minorities interest, then the individual accounts, and you prepare the consolidated balance sheet. So I've thrown a lot of numbers at you. This is also part of your study material, I think, in your test your knowledge, question number 5. So it's an important question as well. So we just tried to discuss the important adjustments to the best extent possible. There is also the preparation of consolidated profit and loss. So we have focused a lot on consolidated balance sheet, but there can also be an adjustment which involves a consolidated profit and loss. So like you consolidate assets and liabilities line by line, you should also consolidate incomes and expenses. Even if you have a 80% stake, you will consolidate 100% of the revenue, you will consolidate 100% of the expenses. And then at the end, whatever is the final profit, you attribute a part of that final profit to the minorities, and the remaining is attributable to the parent. Now over here, what is a thing to be remembered is what is to be done with intercompany items. Like, it is possible that the parent is selling goods to the subsidiary, in which case in the books of the parent it will appear in sales, but in the books of subsidiary it will appear as a part of purchases. The parent may be giving consultancy to subsidiary, in which case it will appear as a part of other income in the books of the parent, but it will appear as a part of other expenses in the books of the subsidiary. So when you prepare the consolidated profit and loss account, you will eliminate the intercompany incomes with the intercompany expenses. You will consolidate 100% of the incomes, 100% of the expenses, and if there are any intercompany incomes, you will eliminate it against the intercompany expenses. Now the challenge over here might sometimes arise in case of upstream or downstream transactions where there is some unrealized profit in inventory. In your income statement, inventory sits inside the line item of changes in inventory. When you prepare the T form of income statement, you have opening stock on one side, closing stock on the other side. However, if you just prepare changes in inventory, in which case you might have a closing stock and you might want to measure the changes in inventory. So if you are measuring the changes in inventory over here, the closing stock will be higher. Like in the last question, your closing stock was 100 rupees, but that 100 included unrealized profit to the extent of 20. So if there is some unrealized profit, that unrealized profit has to be excluded from the changes in inventory item. Typically your closing stock will be higher, and hence you will try to reduce the closing stock, and accordingly you will try to find a revised balance for the changes in inventory. You need to be careful with that. Okay? So over here questions have come in the past for consolidated P&L as well, though it is not as important as a consolidated balance sheet. Consolidated cash flow can also come, but it has never come in the past, in which case you will just total up the cash flow items. Similarly, all items of income and expenditure, all of them are to be added on a line by line basis, and intercompany transactions should be eliminated from the consolidated figures. Intercompany transactions can include sales, purchases, consultancy given or taken, commission income, commission expense. You will eliminate them. If there are any unrealized profits in inventory, this is the important adjustment. It should be eliminated while calculating the total changes in inventory in the consolidated profit and loss. So this will be adjusted from the changes in inventory. So typically, let's say if your opening stock is there and then your closing stock is there. Your opening stock, let us say, was 50, there was no unrealized profit in that. Your closing stock was 100. We will say 100 may say 20 is unrealized, and hence earlier in your books maybe the changes in inventory was appearing at 50 minus 100, that is 50. Now your changes in inventory will appear at only 30 rupees. Your closing stock is higher than the opening stock by 30, and accordingly the workings will progress. The statement of consolidated profit and loss need to be prepared in Schedule 3 format and will involve consolidating entire income and expenses, that is 100%, irrespective of the stake held. Consolidated statement of profit and loss needs to be prepared up to the stage of profit after tax. Any adjustment after this stage need not be done while preparing the consolidated profit and loss. I mean, you can if you want to, but after profit after tax, you will attribute a part of the profits to the minorities. The stake acquired by the parent information is not relevant while preparing statement of profit and loss. Whether you have a 100% stake, 80% stake, it does not really matter. You will consolidate 100% of incomes and expenses. Ultimately, the profit after tax, that is 100%, will be attributed at a later stage between the parent and the minorities. We need to ensure that only the subsidiary's profit after tax is allocated between the parent and minorities. So once you find the profit and someone says how much of this is attributable to the minorities, whatever is the subsidiary's profit into the minorities' interest will be attributable to the minorities. Considering that, you will go to question number 3. Question number 3, let us glance through this. Given below are the profit and loss accounts of H and its subsidiary S for the year ended 31st March 2017. So you have incomes. This is also a study material question. Sales and other income. You will consolidate line by line. Increase in inventory. Acha, increase means your closing stock is increasing. So this must be calculated as closing stock minus opening stock. That is when it is an increase in inventory which is coming on the income side. Raw materials consumed, wages and salaries, production expenses, administrative expenses, selling and distribution, interest, profit before tax, provision for tax, profit after tax, dividend paid, and balance of profit. So we have to do the workings only to the extent of profit after tax, dividend, etc. is an appropriation. Other information, H sold goods to S of 120 lakhs at cost plus 20%. Okay. Inventory of S includes such goods valuing 24 lakhs. So you have sold goods worth 120, but the entire 120 is not unsold. Out of 120, 24 remains unsold. Administrative expenses of S include 5 lakhs paid to H as consultancy fees. Selling and distribution expense of H includes 10 lakhs paid to S as commission. H Limited holds 80% of the equity share capital of 1000 lakhs in S prior to 15/16. H Limited took the credit to its profit and loss account the proportionate amount of dividend declared and paid by S for the year 15/16. Prepare a consolidated profit and loss account. So rather than preparing a full-fledged consolidated profit and loss account, you can try to directly take the totals over here. So ideally your total should be 5000 plus 1000 total. However, are there any adjustments? H sold goods to S for 120 lakhs. H sold goods to S of rupees 120 lakhs at cost plus 20%. Okay, so let us assume 120 lakhs is the selling price of these goods. You can also assume it to be cost, in which case you will take 120 plus 20%. Let us say inventory of S includes such goods valued at 24 lakhs. So over here we will say that this sales, the sales of H will be included over here. So this 5,000 sales will include the total 120 sales, and hence it is intercompany. So we will subtract 120 from the total values. Similarly, this must be a part of purchases as well. So if you go to see raw materials, wages, production, admin, maybe in raw materials consumed, another 120 must be purchases. If H is selling to S, S has purchased from H, and hence that 120 will probably be adjusted over here. Inventory of S includes such goods valuing 24 lakhs. So 24 lakhs is the selling price. 20% on cost, that is 1/5 on cost, is 1/6 on selling price. So if 100 is the cost, then 20%, that is 20 is the profit, then 120 is the selling price. If 120 is equivalent to 24, then 20 is how much? So this is into 1/6, and hence I think the unrealized profit over here is 6. So your closing stock is overstated by 6. So what you can do over here is, your increase in inventory is coming to 1,000 and 200, but in this 200 your closing stock is overstated, let us say by 6. So if you remove this -6, then what will be your increase in inventory is what we try to study over here. Administrative expenses of S include 5 lakhs paid to H. So administrative expenses of H include 5 lakhs. So this is 5 lakhs intercompany for the group as a whole. It's not really an income or really an expense. So you subtract 5 from the expenses, but then you also have to subtract 5 from the incomes. Okay. As consultancy fees, selling and distribution expense of H include 10 lakhs paid to S as commission. So over here there is 10 lakhs selling and distribution minus 10. Again sales and other income, you will subtract minus 10 over here. So both of these get nullified. H owns 80% of equity share capital. Prior to 15/16, H took credit in its profit and loss account for the proportionate amount of dividend declared by S. Do you have the amount? H took credit to its profit and loss account proportionately for the amount of dividend declared and paid by S in the year 15/16. So probably we can say that S is paying a dividend of 150. 150 into 80%, that is 120 rupees. 120 rupees has been included by H in its sales and other income, which is incorrect. This 120 over here is also intercompany. There is dividend income which S is declaring and H is receiving. Now this dividend income, if you go to see, out of which 120 is going to the parent, and even over here in the sales and other income 120 can be reduced. So over here this 120 adjustment is for dividend. Again, you might do it, you might take it to be an out of this is a dividend paid after the profit is determined, but however one can say that out of this 150, 80% is going to the parent, and parent has clearly taken the credit in the profit and loss account. When I am preparing the consolidated profit and loss account, this is 120 of income that I am earning by transacting with my own self, and as a result I will reduce the dividend paid, may say 120, and correspondingly I will also reduce it from sales and other income. Once I do that, I will find the adjusted balances, and these will be the adjusted balances of sales, changes in inventory, raw materials consumed, wages and salaries, production and admin expenses, selling expenses, interest, depreciation, profit before tax, provision for tax, and profit after tax. So you will total these items up, and that is where you will get your final answers. Are we clear with this? Yes? Okay. So this largely takes care of your revision for the purpose of consolidation. We have tried to cover the important adjustments as well as questions over here. I think there's one more question, but that is on accounting policies. I think Doing questions over here is probably not as helpful, specifically the adjustment based questions. You can revise it as well. So over here there was a particular question. I can understand that on a session over here where probably you're not solving a full-fledged consolidation question, it becomes difficult. So we'll just quickly discuss illustration number 4. This is changes in accounting policies. We say uniform accounting policies need to be followed. So over here there is subsidiary B which is providing you with the following balance sheet. This question has come in the past. We'll quickly discuss it once. It gives you the balance sheet of 2010 and then gives you a balance sheet of 2011. So various items. This is only of the balance sheet of subsidiary. There is nothing about the parent over here. Share capital, reserves, short-term borrowings, trade payables, short-term provisions, etc. Then also consider the following information. B is a subsidiary of A. Both companies follow the calendar year as the accounting year. No problem in that. A Limited values inventories on a weighted average basis while B uses FIFO basis. To bring the inventory values in line with those of A, its value of inventory is required to be reduced by 12,000 at the end of 2010 and by 34,000 at the end of 2011. So if you go to C, I'll have to reduce the inventories, let us say by the end of the year, if I say by 34,000. And corresponding to that, the second effect of that would be my reserves would also reduce by 34,000. My closing stock falls, then my COGS rises, and as a result, my reserves will fall by 34,000 as well. Sir, but what about opening stock? Well, opening stock of the current year is the closing stock of the last year. So if I look at the impact on reserves, due to 12,000 rupees at the start of the year, my opening stock is higher in the current year and hence my profit to that extent is lower. This is what reduced. Yes, my opening stock is lower rather. My opening stock is lower by 12,000. So my profits are higher for the current year. But in the last year, my closing stock is lower, which means my profits are lower for the last year and hence the 12,000 gets nullified. 34,000 is going to reduce the closing stock in the current year and correspondingly it will have an impact on the profits. B Limited deducts 1% from the trade receivables as a general provision against bad debts. Probably A is not deducting that. So if A is not deducting that and you want to maintain a consistent policy, you will have to reverse the effect. Like the debtors over here are 8,91,000. Now 8,91,000 is after deducting bad debts. So if 100 minus 1 will come to 99. So if 99 is 8,91,000, then 1 is how much? 100 is how much? So 1 over here will probably come to 9,000. So you will reverse the provision for bad debts to the extent of 9,000. Second effect will go against the retained earnings. Similarly, at the start of the year, you must have had a provision for bad debts to the extent of 6,594 is equivalent to 99. Then 1 is how much? So maybe 6,000 provision and hence during the year a 3,000. So 6,000 was your opening provision for bad debts, 9,000 is your closing provision for bad debts and hence 3,000 is created during the year. Okay. Prepaid expenses in B include advertisement expenses carried forward of 6,000 in 2010, 30,000 in 2011, being a part of initial advertisement expenditure of 90,000 in 2010, which is being written off over 3 years. Similar amount of advertisement expenditure of A has been fully written off in the year 2010. Okay. So what is happening over here is there is a prepaid expense. For example, there's an advertisement expense. In A's books, the entire 90,000 would have been recorded as an expense as and when it is incurred. However, what is B doing? B is recognizing the expense over a period of 3 years. Now, this is a different accounting policy. You want to maintain consistent accounting policy and as a result, B will also recognize the expense similar to that of A. However, till around 2011, out of the 90, B has already recorded 30,000 in the first year, it has already recorded 30,000 in the second year, and as a part of prepaid, another 30,000 is appearing. So in order to ensure that a consistent accounting policy is followed, that 30,000 which is appearing as a part of prepaid in the books of B will have to be removed. So यहाँ से अपन 30,000 निकाल देंगे and instead you will show an expense. Apart from that, for the 3,000 as well, for bad debts you will kind of reverse. You have shown a net 3,000 expense during the year. You will add that back. Your debtors will probably become 9 lakhs. So when you look at the restated balance sheet, your inventory will become 7 lakh 42 minus 34. Your trade receivables will become 8 lakh 91 plus 9, that is 9 lakhs. And your other current assets will come at 48,000 minus 30,000. Retained earnings will be 7 lakh 14 minus 34,000 for the impact of inventory, minus 30,000 because that 30,000 of prepaid expenses which have not yet been written off, the other 60 have been written off, will have to be adjusted. And depending on the assumption that you make, you might adjust 9,000 or you might adjust 9 minus 6, that is 3,000 for the purpose of bad debts, and that will show the restated balance sheet, and that restated balance sheet will be used for the purpose of consolidation. So over here you will use that restated balance sheet for the purpose of consolidation. The question says restate the balance sheet of B as on 31st December 11, only as on 31st December 11 after considering the above information for the purpose of consolidation. Would restatement be necessary to make the accounting policies adopted by A and B uniform? The answer is yes. You will have to restate in order to make the accounting policies uniform. Okay, so I guess that should take care of your revision for consolidation. We have tried to cover the key adjustments and the process. Sums you will have to honestly practice. I can just throw out the important adjustments on what is to be done, on how the bonus is to be accounted, fair value is to be accounted, upstream or downstream is to be accounted. But consolidation is something which you can't just listen and get a grip on. You will have to apply what you have learnt and solve at least 2 to 3 questions properly on pen and paper to have a fairly good understanding. So that should be it. Thank you very much for your time and patience. Do let me know if you have any queries or doubts.